Imagine this. You're sitting in a quiet room. A thick notebook lies on the table in front of you. Not a normal notebook, but a treasure map. Each page holds clues, not to hidden gold in the ground, but to something far more powerful. The ability to spot extraordinary businesses before the world notices them. That is the spirit of the Buffett's Investment Workbook. It's not just a book. It's a training ground that teaches you how to think like Warren Buffett. What if you could sit beside Warren Buffett, peek over his shoulder, and watch how he decides where to place billions of dollars? Buffett's Investment Workbook invites you to do exactly that. Key lessons. 1. The business detective mindset. You learn to stop guessing and start investigating. Not, will this stock go up tomorrow? But, is this business so strong it can grow for 10, 20, 30 years? You become a detective of business quality. 2. The search for the economic castle. Great businesses are like castles with deep moats, strong brands, customer loyalty, pricing power. The workbook trains your eyes to spot these moats in financial statements, not in stories or hype. 3. Simple numbers, powerful truths. No complex math, no intimidating formulas, just a few simple calculations that reveal: is profit growing steadily? Is management using money wisely? Are shareholders getting richer over time? The workbook turns financial statements into an open book, not a mystery. 4. The power of patience. The lesson repeated again and again. You don't need many great investments, just a few wonderful businesses, held for a long time. The workbook rewires your brain away from trading, toward ownership. 5. Doing it yourself. This is the heart of the workbook. Not reading about investing, not listening to opinions, but applying checklists, filling worksheets, making real decisions, like Buffett himself. By the end, you're no longer following tips. You're thinking independently. Buffett's Investment Workbook doesn't promise quick money. It promises something far greater: a clear mind, a disciplined process, and the confidence to recognize a great business when you see one. So the question is, are you ready to open the workbook and begin thinking like Warren Buffett? Introduction. Warren Buffett didn't make his fortune by chasing the loudest trends on Wall Street. He made it by ignoring them. While the crowd rushed into internet darlings and biotech gold rushes, Buffett quietly stood on the sidelines. He missed the headlines, skipped the mania, and still turned an original stake of $105,000 into a multi-billion-dollar empire. That kind of result isn't magic, it's method. The secret is simple and, at first glance, counterintuitive. Buffett doesn't play the stock market, he plays the people who do. Most investors and institutions are short-term motivated. They buy on hype and sell on fear. That collective short-sightedness creates predictable swings, the euphoria that inflates prices, and the panic that crushes them. Buffett's genius was recognizing that those swings often have little to do with a company's long-term economic value. When Wall Street overvalues a business, its shareholders eventually pay the price. When Wall Street panics and undervalues a great business, opportunity knocks, loudly, and for a short time. Buffett's edge was patience and the courage to buy when the headlines screamed, "Sell." He loved bargains born of bad news because long-term economics tend to reassert themselves. The true value of a strong business eventually shines through. This workbook gives you Buffett's playbook, the mindset and the tools to spot great businesses that are temporarily out of favor, and the math to know the right price to pay. Knowing which businesses have durable economic advantages is only half the battle. The other half is valuation. Pay too much, and even a great company won't deliver great returns. Buy at the right price, and compounding becomes a powerful ally. We'll start with the qualitative, how to judge a company's economic moat, management quality, and resilience in the face of short-term storms. Then we move to the quantitative, the exact calculations Buffett uses to project annual compounding rates and decide whether an investment makes business sense. Don't worry if numbers make you uneasy. We walk you through each equation and show how to use a financial calculator to do the heavy lifting. Throughout, you'll find case studies, templates, and worked examples so you can apply Buffett's methods step by step. The learning curve is friendly. The implementation is the hard part. Buying on bad news requires both conviction and discipline. Most readers will understand the ideas. Fewer will have the nerve to act. But for the disciplined few, this approach can unlock decades of compounding wealth. So sharpen a pencil, power up your calculator, and get ready to think like Buffett. This isn't trading. It's a way of seeing. A long-term, business-centered lens that finds treasure where others see only trouble. Let's begin. Part 1. Understanding Value Investing. Chapter 1. The Short-Sighted Mess and the Bad News Phenomenon. The Gifts That Keep on Giving. The day everyone sold, except one man. Imagine this. The year is 1973. The U.S. economy is wobbling, newspapers are losing ad revenue, and panic is in the air. Investors are dumping shares of the Washington Post company like it's cursed paper. The headlines are filled with fear. But in the middle of this chaos, a calm man in Omaha is reading those same headlines with a faint smile. While the world sees bad news, Warren Buffett sees a gift wrapped in panic and tied with the ribbon of short-sightedness. He quietly buys 1.7 million shares at just $6.14 each, and then he waits. Decades later, those same shares are worth over $500 each, turning a modest $10.2 million into nearly $864 million. What happened here? The answer lies in two invisible forces that rule the stock market, and that Buffett learned to use in his favor. Short-sightedness. The bad news phenomenon. The lesson. Why everyone else misses. What Buffett sees. The average investor, whether it's a day trader or a fund manager, lives for instant gratification. They don't invest, they react. They chase every hot stock, every quarterly result, every rumor. They live by one rule: make money now or move on. Mutual fund managers are under constant pressure. If their fund doesn't perform this quarter, they might lose investors or their jobs. So they chase performance, not value. When bad news hits, say a company reports lower earnings, or the media exaggerates a setback, the herd rushes for the exits. Stocks tumble. The headlines scream. Fear spreads. And that's when Buffett steps in, because he knows something simple yet profound. In the short run, the market is a voting machine, but in the long run, it's a weighing machine. He doesn't care about today's votes. He's interested in what the company will weigh, its true value, 5, 10, or 20 years from now. Buffett's secret: turning panic into profit. To Buffett, bad news isn't a threat, it's an invitation. When fear drives stock prices down, it's like the market is offering him a sale on great businesses. He looks for what he calls consumer monopolies, companies with such strong brands, products, or customer loyalty that they can survive almost any storm. Think Coca-Cola, Gillette, or American Express. When these companies face short-term trouble, Buffett doesn't flinch. He buys, because he knows their economic engine is too powerful to stay down for long. Teaching breakdown. 1. The short-sighted mess. Most investors think in days and weeks, not years and decades. Mutual fund managers chase performance because their jobs depend on it. The result? Everyone reacts emotionally to short-term noise. 2. The bad news phenomenon. Every time bad news hits, people panic sell. Stock prices drop, often far below their true value. This bad news creates buying opportunities for calm, disciplined investors. 3. The Buffett advantage. Buffett patiently waits for these moments. He only buys companies with long-term competitive advantages, consumer monopolies. When the herd sells, he buys quality at a discount. The moral of the chapter. Lesson. The market's short-sightedness is not your enemy. It's your opportunity. True wealth comes from thinking in decades, not days. Bad news doesn't destroy great businesses. It discounts them. Invest in companies with economic moats, Buffett's consumer monopolies. Be patient. Be fearless when others panic. That's how fortunes are made. Final thought. The stock market constantly overreacts to headlines, emotions, and temporary setbacks. But if you can stay calm when everyone else is losing their nerve, if you can see value where others see disaster, you hold the same golden key that Warren Buffett has used for over half a century. The ability to stay rational when everyone else is emotional. That is the first step in understanding the true art of value investing. Chapter 2. Identifying the Economic Engine Warren Wants to Own. How Warren Buffett finds businesses that keep making money even when the world panics. Imagine this. The stock market is in chaos. Headlines scream, recession, layoffs, collapse. Investors rush to sell their shares, terrified of losing more money. Prices tumble. Fear spreads like wildfire. And in the middle of that panic, one man calmly writes a check. That man is Warren Buffett. While everyone else sees disaster, Warren sees opportunity. But here's the secret. He doesn't buy every cheap stock. He buys only those with an economic engine so powerful that even a storm can't stop them. This chapter is about discovering what makes those engines run. Because if you can spot what Buffett sees, you can turn market fear into your fortune. The lesson in the story, the two racehorses. Let's start with a simple story. You own two racehorses, healthy and sickly. Both horses fall ill and can't race for a year. Their prices drop, and the owners, frustrated, decide to sell. Now you have a choice. Which one would you buy? If you're wise, you'd pick healthy, because you know that once recovered, healthy will race again and win. Sickly, however, might never regain its strength and will likely keep getting sick. That's exactly how Warren Buffett looks at businesses. He doesn't mind buying a company when it's sick with bad news, as long as its business model, its economic engine, is fundamentally strong. Once the storm passes, that healthy company will come roaring back, stronger than ever. Teaching. Insight, what Buffett actually looks for. Warren Buffett divides all businesses into two main categories. 1. The sickly ones, commodity-type businesses. These are companies that sell generic products everyone else sells too. There's no unique brand, no special customer loyalty. They must constantly compete on price, which means thin profits and no real power. Examples: steel, oil, airlines, or textile companies. Buffett avoids these like a bad horse because no matter how cheap they look, their future profits are weak. 2. The healthy ones, consumer monopoly businesses. These are companies with a strong brand, unique position, or customer loyalty that no one else can copy. They can raise prices without losing customers. They keep making profits, even when the economy slows down. Examples: Coca-Cola, Geico, the Washington Post. Buffett calls these consumer monopolies because even though they aren't legal monopolies, their strength in customers' minds gives them the power as if they were one. Real-life Buffett magic, turning panic into profit. When everyone on Wall Street ran from Geico and the Washington Post, Buffett walked in. He saw great businesses temporarily hit by bad news. Geico later gave him a 5,230% return. The Washington Post earned him an astonishing 7,930% return. That's the power of identifying a strong economic engine during weak times. He didn't just buy cheap stocks, he bought great companies temporarily on sale. The Buffett rule to remember: a stock well bought never has to be sold. Warren Buffett. When you buy a company with a strong economic engine, time becomes your friend. Its profits compound, its value grows, and you don't need to constantly chase the next hot thing. Moral of the chapter: to invest like Warren Buffett, you must learn to distinguish between healthy and sickly businesses. Not every low-priced stock is a bargain. Focus on companies with lasting competitive advantages. These are the consumer monopolies that keep winning over time. Use market fear to your advantage. When others sell great businesses on bad news, that's your opportunity. Think long-term. You're not buying a stock. You're becoming a part owner of an economic machine that keeps earning money year after year. Final thought. In Buffett's world, the stock market is like a voting machine in the short term, emotional and unpredictable. But in the long run, it's a weighing machine rewarding businesses that truly earn their worth. Your job is to identify those businesses that will keep growing their profits no matter what storms come their way. Because when you find the right economic engine, you don't just invest in a company, you invest in a lifetime of compounding success. Chapter 3. The Price War Trap. Identifying the sick commodity type business. Imagine two lemonade stands side by side on a hot summer day. Both sell the same cold lemonade. You approach one, $10 a glass, says the seller. The other shouts, $6. Which one do you buy from? Exactly. You pick the cheaper one. Now multiply this scenario by millions of customers, billions of dollars, and hundreds of competing companies. Welcome to the world of commodity-type businesses. The sick kind of businesses Warren Buffett warns us to avoid. The lesson: understanding the commodity trap. Commodity-type businesses sell products or services that are nearly identical to their competitors' offerings. In such industries, price becomes the main reason customers buy. When people choose based on price, not brand, companies are forced into a never-ending price war, where profit margins shrink, debts grow, and long-term investors suffer. Everyday examples of commodity-type businesses: airlines, steel producers, gas and oil companies, raw food producers like rice, wheat, corn, paper and lumber industries, automobile manufacturers. These industries sell products that are basically the same, so the cheapest one usually wins. The cycle of doom: why these businesses stay sick. Let's walk through the vicious cycle that keeps commodity businesses trapped. Company A lowers production costs, profit margins rise. A lowers prices to grab more customers. Competitors B, C, and D copy the same process and also lower prices. Prices drop across the industry. Margins vanish again. Everyone is back where they started, only poorer and more exhausted. This endless cycle keeps profit margins razor thin. Even great management teams can't escape it, because the industry itself has poor economics. The low-cost producer rule, Buffett's golden formula. In commodity-type businesses, the low-cost producer always wins. Here's the simple formula behind it. Profit margin is equal to selling price minus cost of production. If you can produce something cheaper than your competitors, you can either sell at the same price and make more profit, or sell cheaper and steal market share. But this advantage doesn't last long. Others soon catch up, and the race to the bottom begins again. A real example: the auto industry trap. During economic booms, companies like Ford or GM make huge profits and expand their factories. But when demand falls, and it always does, they're stuck with massive factories, high labor costs, fat dividend payments. In downturns, these expenses turn deadly. For example, General Motors lost $9.6 billion between 1990 and 1993, a mild recession. Even after decades of growth, their long-term debt still crushed their profits. The Buffett wisdom: when management with a great reputation meets a business with a bad reputation, it's the business's reputation that remains intact. No matter how talented the CEO is, if the business model is weak, it can't produce long-term wealth. Buffett learned this lesson the hard way with his own textile company, Burlington Industries. Decades of effort, billions in capital, and almost no shareholder gains. Spotting a commodity-type business. Buffett's checklist. 1. Low profit margins. If a company's profit margin is tiny, like 1-3%, it's likely in a commodity business. Example from Buffett's value line data. Here's some examples. Data according: company industry and net profit margin. Burlington Industries Textiles, 1.4%. Coca-Cola Beverages, 16.3%. UAL Corp., Airline, 4.4%. Microsoft Software, 38.6%. Boise Cascade, Paper, 2.2%. The higher the profit margin, the stronger the company's economic moat. 2. Low return on shareholders' equity, ROE. ROE tells us how efficiently a company uses shareholder money to generate profits. Formula, in simple terms, ROE is equal to net income divide by shareholders' equity multiplied by 100. The average U.S. company ROE is around 12%. Anything below that usually signals poor business economics. Here's some examples. Data according. Company industry and ROE. Burlington Industries. Textiles, 3.6%. Coca-Cola Beverage, 32.5%. UAL Corp. Airline, 15.5%. Microsoft Software, 26.8%. Boise Cascade Paper, 10%. Buffett's clear message: avoid companies with low ROE. They're wealth destroyers. 3. No brand loyalty. If people don't care which brand they buy from, gasoline, paper, steel, the company has no moat. Without a moat, price wars destroy profits. 4. Too many producers. The more players in the game, the more brutal the price cuts. Example: airlines, motor oil brands, cement, steel. 5. Excess production capacity. When companies build more factories than needed, they create oversupply, which leads to falling prices. The cycle repeats endlessly. Boom, overproduction, bust. 6. Erratic profits. If a company's earnings graph looks like a roller coaster, it's likely a commodity-type business. Buffett prefers businesses with steady, predictable earnings, not wild ups and downs. 7. Dependent on tangible assets. If the company's profits depend mainly on heavy machinery, planes, or plants, it's a red flag. Buffett prefers businesses that earn from intangible assets like brands, patents, or network effects. Think Coca-Cola or Apple. The moral of the story: commodity-type businesses may look shiny during good times, but they're financial traps in disguise. They earn little during recessions, need constant reinvestment just to stay afloat, rarely compound wealth over time. That's why Buffett avoids them, not because they're bad, but because they lack lasting advantage. Key takeaways: the Buffett checklist to avoid sick businesses. Here's some examples. Data according. Red flag and what it means. Low profit margins. Price wars destroy profits. Low ROE, poor use of shareholder capital. No brand loyalty. No customer stickiness. Many producers. Too much competition. Excess capacity supply greater than demand. Prices fall. Erratic profits. Unstable business model. Heavy tangible assets. Low scalability and flexibility. Final thought: Buffett's secret isn't just picking great companies, it's knowing what to avoid. He'd rather wait patiently for a wonderful business at a fair price than gamble on a fair business at a wonderful price. Because in the long run, price wars fade, but brand power compounds. Chapter 4. The Healthy Business, the Consumer Monopoly, where Warren finds all the money. If you own a toll bridge, you don't have to worry about traffic. The cars will always come. Warren Buffett loves businesses like that. Why? Because they don't just sell products. They own a place in the customer's mind. Let's start with a little imagination. Picture yourself driving on a long highway. Suddenly, you reach a wide river. There's only one bridge to cross. No other routes, no ferries, no shortcuts. You either pay the toll or you stay stuck. Now imagine that bridge is Coca-Cola, Gillette, or Microsoft. Millions of people cross that bridge every single day, paying their little toll each time they drink a Coke, shave with a Gillette razor, or boot up Windows. This is what Warren Buffett calls a consumer monopoly, his favorite kind of business in the world. What is a consumer monopoly? A consumer monopoly is a business that owns a unique space in the market, not because of government laws, but because of customer loyalty, habit, and trust. It's when people don't just want the product, they want that brand's version of the product. Buffett says these businesses are healthy because they can survive almost anything: recessions, bad news, or even mistakes. Why? Because their customers keep coming back, again and again. The toll bridge analogy, Buffett's favorite example. Warren often says owning a consumer monopoly is like owning a toll bridge. Once you build it, people have no other way to cross. Want to chew gum? You'll likely buy Wrigley's. Want a refreshing cola? It's Coca-Cola. Want to shave? Gillette. Need an operating system? Microsoft Windows. These brands have monopolized consumer preference. They don't need to beg customers. Customers find them. That's how they can charge premium prices and still keep people happy. Higher prices is equal to higher profit margins is equal to massive shareholder returns. The secret behind these companies. Goodwill. Before Buffett, an insightful researcher named Lawrence N. Bloomberg, 1938, studied this phenomenon in his dissertation, The Investment Value of Goodwill. He discovered that goodwill, the emotional connection consumers feel toward a brand, creates a form of monopoly. Bloomberg found that goodwill comes from things like a convenient location, courteous employees, quality products, memorable advertising, secret formulas or patents. He realized that companies with strong goodwill consistently earn higher profits and better long-term stock performance. Warren later took this insight and built an empire on it. Buffett's 2 tests for a consumer monopoly. Buffett has a simple way to identify whether a company truly owns a consumer monopoly. Test 1, the zero net worth test. If the company gave away all its assets but still had customers coming back, would it still be valuable? If yes, you've found a monopoly. Example: even when American Express and Geico lost almost everything on paper, their brand loyalty and customer base still had huge value. Warren bought them and made a fortune. Test 2, the competition test. If I had billions of dollars and the best managers in the world, could I start a company to compete with this one? If the answer is no, the company has an unbeatable moat, the Buffett term for consumer monopoly power. Try to compete with Coca-Cola, Wrigley's, or Microsoft. You could spend billions and still fail. That's the power of owning the customer's heart. Buffett's real-world examples. Coca-Cola, available in every corner of the world. Even remote mountain stands in Indonesia sell Coke. Marlboro. Try convincing a Marlboro smoker to switch. Impossible. Gillette. Millions use it daily out of habit. Microsoft. Its Windows system is so embedded that replacing it is a nightmare. These brands are so essential that stores must stock them or lose customers. Buffett calls this being indispensable. Why consumer monopolies stay rich. Consumer monopoly businesses have several financial advantages. 1. Low debt, high cash flow. They don't need to borrow much because they're always generating cash. Example: Wrigley and Hershey operate with almost no debt. 2 simple operations. They make low-tech products, gum, chocolate, razors, that don't need constant reinvention. 3. Longevity. Their equipment lasts for decades. Gum machines don't go out of style. 4. Intangible wealth. Their power comes from brand and customer loyalty, not factories or machinery. 5. Tax efficiency. Since they have fewer physical assets, their tax burden flexes with profits, unlike heavy industries such as General Motors. The timeless truth, owning the consumer's mind. From the Venetian traders of silk to the British Empire's steel monopoly, history shows that wealth always flows to those who own the perception of quality and trust. That's why Buffett invests in brands like GE, General Electric, electricity and appliances, Coca-Cola, happiness in a bottle, Microsoft, the world's operating system. Each is a modern toll bridge. You have to pay the toll to cross. The moral, what Buffett teaches us. Buffett's message is simple but profound. If you want to build wealth, own the bridge everyone must cross. Key lessons to remember. 1. A consumer monopoly is a business people must buy from, not because of laws, but loyalty. 2. Buffett's tests help identify these monopolies. If it lost all assets, would it still be valuable? Can you realistically compete with it? 3. The strongest brands win not by lowering prices, but by owning customer trust. 4. Even great companies face tough times, but their core strength always pulls them back. 5. The best investments aren't found in trendy tech. They're in simple, timeless businesses with deep consumer roots. Final thought. Next time you sip a Coke, shave with a Gillette, or use Windows, remember, you're paying a tiny toll to a bridge that Warren Buffett owns a piece of. And that's why he's one of the richest people alive. In the world of investing, the goal isn't to build more bridges, it's to own the ones everyone needs to cross. Chapter 5. The Treasure Map to Wealth. How Warren Buffett Finds His Consumer Monopolies. The Secret Treasure Hunters. Imagine you're an old-school treasure hunter. You've got your shovel, your compass, and your dream. But before you start digging, you need a map. Now, in the world of investing, Warren Buffett is the ultimate treasure hunter. But instead of gold, he hunts for something even rarer. Consumer monopolies. Businesses so powerful that competitors can't touch them and customers can't live without them. Warren's genius lies not in chasing hype or trends, but in finding businesses built to last. Companies that keep making money year after year, no matter what storms hit the market. But how does he find them? He doesn't guess. He uses a set of timeless questions like a treasure map that leads straight to the gold. Let's walk through Warren's process, one question at a time, and learn how to spot your own consumer monopoly gems. Step 1. Can you identify a consumer monopoly product or service? Buffett starts simple. Is the company selling something that people just won't give up? Let's play a quick game. Name a soda you can buy anywhere in the world. Coca-Cola. A newspaper everyone knows. The Wall Street Journal or USA Today. A razor blade you've probably used. Gillette. A kids' movie every parent has bought twice. Disney's The Little Mermaid. These are not just products. They are habits, emotions, and memories bottled into a brand. That's what Buffett calls a consumer monopoly, when a product has such strong emotional or habitual pull that people ignore cheaper alternatives. Teaching tip. A consumer monopoly is equal to a company whose customers can't easily switch, even if competitors cut prices. Step 2. Do historical earnings show a strong upward trend? Buffett loves predictability. A great company doesn't just make money, it makes more every single year. Let's compare two examples. Year company 1 Coca-Cola like. 1990 $1.0 serving dollar. 1995 $1.60. 1999 $2.69. And company 2 Unstable business. 1990 $1.5 of $7. 1995 $0.60. 1999 $0.99. Company I's profits rise steadily, strong, reliable, and upward trending. Company 2's profits jump around, a clear red flag. Buffett would choose Company I because steady earnings is equal to strong business fundamentals. Even if a company faces temporary problems, like Coca-Cola once did, Buffett looks deeper to see if the problem is short-term pain in a long-term gem. Step 3. Is the company loaded with debt? Buffett hates debt the way a sailor hates holes in his boat. He asks, can the company pay off all its long-term debt with just 1 or 2 years of earnings? If yes, the company is financially strong. Here's a simple Buffett-style formula. Debt strength ratio is equal to long-term debt divided by annual net earnings. Good business, ratio less than or equal to 3. Risky business, ratio greater than 3. Example, Coca-Cola, debt is equal to 1 year's earnings. Safe. Ford GM, debt is equal to 10 years' earnings. Risky. Consumer monopolies like Wrigley's or Coca-Cola have low debt because they generate massive cash flow. That's why Buffett says, cash-rich businesses sleep well at night. Step 4. Does the company earn a high return on shareholders' equity, ROE? This is Buffett's favorite measuring stick. He asks, for every dollar shareholders have invested, how much profit does the company generate? The formula is simple. ROE is equal to net income divided by shareholders' equity multiply by 100. If a company earns 15% or more consistently, Buffett smiles. Example: Coca-Cola, 25% to 33% average ROE. McDonald's, 18%. General Motors, 8%. High ROE means the company not only earns well, but also uses its money efficiently, a hallmark of a strong consumer monopoly. Step 5. Does the company have to spend a lot just to stay afloat? Buffett learned from his mentor Benjamin Graham that not all profits are real profits. If a company spends all its money replacing machines or upgrading tech just to survive, it's running on a treadmill, working hard but going nowhere. He wants businesses like Hershey or Wrigley, which make simple products, don't require huge reinvestments, and rarely go obsolete. Lesson: a great company makes money and keeps it, instead of constantly spending to stay alive. Step 6. Are retained earnings used wisely? Buffett's magic question: what does the company do with the money it keeps? A brilliant business reinvests retained earnings into expanding profitable ventures or buying back its own shares, which increases shareholder value. Let's see how money grows with reinvestment. If a company earns and reinvests at 23% annually, then $10,000 invested for 20 years is equal to $3,306.59. That's the magic of compounding when money starts earning money on itself. Buffett looks for companies that use retained earnings to multiply value, like Capital Cities, Sara Lee, or Philip Morris did in their prime. Warren's wisdom, the marriage analogy. Buffett jokes, in investing, it's better to act like a Catholic. Marry for life. He means, choose your investments as if you'll hold them forever. Before you marry a company, make sure it's financially strong, it treats earnings wisely, and it has that magic consumer monopoly edge. The 8 Buffett questions, your treasure map. 1. Can you identify a consumer monopoly product and service? 2. Do earnings show a strong upward trend? 3. Is the company free of heavy debt? 4. Does it earn a high ROE 15% plus? 5. Does it spend little to maintain operations? 6. Are retained earnings reinvested smartly? 7. Can it adjust prices for inflation? 8. Does retaining earnings increase long-term market value? Moral of the lesson: a consumer monopoly isn't just a brand. It's a wealth machine powered by trust, habit, and smart management. Warren Buffett's formula for identifying them teaches us that great businesses earn predictably, grow naturally, use debt wisely, and turn retained earnings into more profits. If you can find such a company and buy it at a fair price, you've found your treasure chest. And like Warren, you can sit back and watch the gold grow year after year. Chapter 6. Where to look for a consumer monopoly. The hidden bridges to endless profits. Imagine standing before a wide, rushing river. On the other side lies a mountain of gold, shining, tempting, and waiting to be claimed. But there's only one bridge across, and it has a toll gate. Anyone who wants to cross must pay the fee. Now imagine owning that toll bridge. That, in essence, is how Warren Buffett sees a consumer monopoly. It's not just a company, it's a toll bridge in the business world, where customers, retailers, or even other businesses must pay the toll to use its product or service. And the best part? Once that toll bridge is built, the money keeps flowing in, year after year, with very little extra effort. But where do you find such rare and powerful businesses? Let's join Warren as he takes us on a treasure hunt to the 4 hidden toll bridges that have made him one of the richest men in the world. The 4 bridges to monopoly riches. Warren discovered that businesses with true consumer monopolies usually fit into one of these 4 categories. 1. Products that wear out quickly or get used up, but are loved by consumers. 2. Communications and advertising channels that manufacturers must use. 3. Services that people and businesses constantly need. 4. Retail stores that dominate a region by selling high volume at low prices. Let's explore each one like a detective, understanding why they're so powerful. 1. The first toll bridge, Brand name everyday products. The power of you have to carry it. Picture a small convenience store, a quick shop, or 7-Eleven. Before you even walk in, you can already predict what's inside. Coca-Cola, Marlboro cigarettes, Hershey's chocolate, Wrigley's gum, and Doritos. Now here's the secret. The store must carry these items. If they don't, customers walk out. That means the power shifts from the store owner to the manufacturer. If Coca-Cola decides to raise its price a little, the store has no choice but to pay it. Because if they don't stock Coke, they lose sales. This is Warren's favorite kind of toll bridge, when the brand itself controls the gate. Every time someone reaches for a Coke or a Gillette razor, they're paying a small toll. Not to the store, but to the brand that owns their loyalty. Buffett's examples: Coca-Cola, drinks; Gillette, razors; Hershey's, chocolate; WD-40 lubricant; Nike, shoes. Even restaurants play this game. Nobody walks in and says, "Gimme Bob's Cola." They ask for Coca-Cola by name. That's brand power. Teaching insight. The real secret here is pricing power. A company with strong brands can quietly raise prices without losing customers. And that's how wealth compounds over time. 2. The second toll bridge, communication channels. Where companies pay to reach you. Now imagine a bridge not for consumers, but for manufacturers. How do companies reach their customers? Through advertising, TV, newspapers, radio, and now the internet. These are the advertising toll bridges of the world. If a car company wants to sell its new model, it must advertise. It has no choice. Otherwise, its competitors will dominate the consumer's mind. For decades, television networks like ABC and CBS were the only bridges across this river. Every manufacturer had to pay to cross by buying ad space. Warren saw this early and invested heavily in capital cities like ABC, turning media into money. Similarly, newspapers in one-city towns, like the Buffalo Evening News, are another toll bridge. With no competitor, they can charge advertisers any rate they want and still get paid. Teaching insight. Whenever there's only one main path to reach the audience, that's a toll bridge. Warren calls these communication monopolies. Even today, think of Google Ads, YouTube, or Meta, Facebook, modern digital toll bridges. 3. The third toll bridge, repetitive consumer services. Businesses that get paid again and again. Let's move to another kind of bridge, one you cross not once, but over and over. These are service companies that people and businesses always need. Think of pest control, cleaning, or tax services. Companies like ServiceMaster, cleaning, lawn care; Rollins, Orkin, pest control, security; H&R Block, tax preparation; American Express, credit cards. American Express is a genius example. Every time someone swipes their card, Amex collects a small toll from both the user, through interest or fees, and the merchant, through transaction charges. Multiply that by millions of transactions, and you have a gold mine. What's beautiful about these companies is that they don't need huge factories, have low overhead, offer services people keep needing. Teaching insight. The magic lies in repetition. Every month, every year, the same customers keep paying to cross. That's financial gravity, the kind of business that doesn't just make money, but attracts it automatically. 4. The fourth toll bridge, regional retail giants. The power of scale and loyalty. Now let's step into the world of big retail, where stores like Nebraska Furniture Mart or Borsheim's Jewelry, both owned by Buffett, rule their territories like kings. How? By selling at the lowest price, but making up for it with massive volume. This gives them something called monopoly buying power. Because they buy in such large quantities, manufacturers give them big discounts. They can then sell cheaper than any competitor and still make a profit. Over time, this creates a regional monopoly, a store so loved, so affordable, and so trusted that new competitors can't even afford to start. Teaching insight. In these cases, the moat is built from customer loyalty, economies of scale, and reputation, not just price. When customers trust you and competitors can't undercut you, you've built a fortress. Warren's simple strategy to spot a consumer monopoly. Next time you're at a supermarket, just stand by the entrance. Try naming all the brand name products that the store must carry to stay in business. Coca-Cola, Gillette, Listerine, Advil, Nike, Hershey's, WD-40. Those are your treasure maps. Each one points to a company that owns a toll bridge, one that customers keep crossing and paying for year after year. Summary: the 4 golden toll bridges. Warren Buffett often refers to his favorite businesses as toll bridges, companies that charge customers to cross again and again with little competition on the other side. These businesses enjoy strong consumer monopolies because people either must use their products or prefer them so much that switching isn't an option. Let's explore the 4 main types. 1. Products that wear out quickly. Think of Coca-Cola, Gillette, or Nike. Their products are used, loved, and then replaced again and again. Because of powerful brand loyalty, customers don't even look for alternatives, giving these companies the power to raise prices without losing buyers. 2. Communications and advertising monopolies. Media giants like ABC, Gannett, or Google control the bridge between businesses and customers. Companies must pay to get their message across these channels. This necessity gives such firms recurring income and immense influence over pricing. 3. Repetitive consumer services. Services such as American Express and H&R Block thrive because people need them regularly, whether it's swiping a card or filing taxes. Their customers return year after year, creating a cycle of predictable, repeat business. 4. Regional retail monopolies. Local legends like Borsheim's Jewelry or Nebraska Furniture Mart dominate their territories. Their size, reputation, and loyal customers create barriers that new competitors can't easily cross, turning geography and trust into protective walls. In short, each of these golden toll bridges allows money to flow steadily, predictably, and profitably. The kind of business Warren Buffett loves most. Moral of the chapter: if you want to find a golden business, don't dig through numbers first. Look for the bridge everyone must cross. Once you find it, own part of that bridge, and you'll collect tolls for life. Chapter 7. The Bad News That Creates a Buying Situation. How Warren Buffett Turns Panic into Profit. When the world panics, Warren smiles. Imagine this. The stock market is crashing. Headlines scream, "Investors lose billions." People are selling their stocks in fear. Everyone's running for the exit. But in the middle of all that chaos, there's one man sitting quietly in his office in Omaha, sipping a can of Coca-Cola, smiling. That man is Warren Buffett. While others are panicking, he's calmly writing big checks, buying stocks that everyone else is desperate to sell. Why? Because he knows one timeless truth. Bad news is the friend of the long-term investor. This chapter is about how Warren turns moments of fear into moments of fortune, how he identifies when bad news is actually good opportunity. Let's learn the art of seeing gold where others see gloom. The lesson behind the panic. Warren's secret isn't luck. It's pattern recognition, knowing which kinds of bad news are temporary setbacks and which ones signal real trouble. He calls these the 4 bad news opportunities. 1. Stock market corrections and panics. 2. Industry recessions. 3. Individual company calamities. 4. Structural changes. Let's dive into each through Warren's stories. 1. Stock market corrections and panics. The safest kind of bad news. When the market crashes, people sell everything, good companies and bad ones alike. But the businesses themselves don't stop making money. Their stock prices drop, but their earnings power stays strong. That's when Warren pounces. Example: the Washington Post and Coca-Cola. During the 1973-74 crash, the Washington Post's stock fell off a cliff. In 1987, Coca-Cola's stock was hammered in a global panic. Did people stop drinking Coke? Did readers stop buying newspapers? Of course not. Warren knew their business engines were still running strong, just temporarily undervalued. So he bought like a man possessed, turning short-term chaos into long-term gold. Be fearful when others are greedy, and greedy when others are fearful. Buffett. Teaching point. A market panic doesn't change a company's core economics. It only changes the price tag. If the company has a consumer monopoly, it will recover, and likely faster than anyone expects. 2. Industry recession. When the whole sector falls asleep, sometimes an entire industry goes through a downturn, profits fall, layoffs rise, and stock prices plunge. But not all companies are created equal. The strong survive and emerge stronger. Example, Wells Fargo, 1990. When the real estate market crashed in 1990, every bank looked doomed. Wells Fargo set aside billions for potential loan losses, Wall Street panicked, and the stock fell from $86 to $41. But Warren saw through the fear. He realized Wells Fargo wasn't in real danger. It was just preparing for bad times. He invested heavily, buying 10% of the company. 9 years later, Wells Fargo's stock had grown more than 6 times, giving Warren an 18.6% annual return. Teaching point. During an industry recession, everyone suffers, but only the best survive. Look for the well-managed, financially strong leader. When the industry rebounds, these leaders soar. 3. Individual calamity. When great companies make temporary mistakes, even the smartest companies do dumb things sometimes. But if they have a consumer monopoly, they can recover, and investors who believe in them make fortunes. Example, GEICO, 1970s. GEICO started insuring everyone, not just safe drivers. Losses skyrocketed. Bankruptcy loomed. But Warren met the new CEO, Jack Byrne, who had a solid recovery plan. Go back to insuring only preferred drivers. Warren invested $45 million. By 1996, that stake was worth $2.3 billion, a 28% annual return for 16 years. Example, American Express, 1960s. American Express once guaranteed $60 million worth of non-existent salad oil. When the fraud was revealed, the company nearly collapsed. But Warren saw that its core monopoly, credit cards and traveler's checks, was untouched. He invested 40% of his partnership's capital. Within 2 years, the stock rebounded, and he made $20 million in profit. Teaching point. Ask yourself, is the company's core business engine still intact? If yes, short-term calamities are once-in-a-lifetime discounts. 4. Structural changes. When the company is reinventing itself, mergers, reorganizations, or spin-offs often bring short-term pain. Earnings drop, headlines turn negative, and stocks fall. But for Warren, this is a moment to look closer. Sometimes, those same changes lay the groundwork for long-term growth. Example, Costco and Sears. Warren invested in Costco after it suffered temporary losses due to restructuring. He also saw potential in Sears when it spun off Allstate, unlocking hidden value. Teaching point. Restructuring noise can hide opportunity. Temporary charges against earnings might actually signal future efficiency and profitability. Conclusion, the art of buying bad news. Warren Buffett's genius doesn't come from predicting what the market will do next. It comes from his ability to stay calm when everyone else is losing their heads. While others panic and sell in fear, Warren quietly studies, waits, and buys. He understands that bad news often gives birth to the best buying opportunities. When fear grips the market, prices fall. But great businesses don't suddenly stop being great. They just go on sale. Warren calls these moments gifts, rare chances to buy wonderful companies at bargain prices. There are 4 kinds of bad news situations that make Warren's eyes light up. First, there's the market panic, when stocks fall for no reason other than fear itself. The economy might still be fine, and the company's profits still strong, but the stock price collapses. To Warren, this is the safest time to buy. The business hasn't changed, only its price tag has. Next comes the industry recession. Here, an entire sector goes through tough times. Maybe banks, automakers, or tech companies all face lower profits. Warren looks for the strongest player in the pack, the one with solid management, good cash flow, and a strong reputation. These are the survivors that will thrive when the storm passes. Then comes the individual calamity, when a great company makes a big blunder or gets caught in a temporary mess. Most investors run away, but Warren studies whether the mistake damages the company's core business. If not, if its monopoly or customer loyalty stays intact, he knows recovery is only a matter of time. Finally, there are structural changes, mergers, reorganizations, or spin-offs that temporarily hurt profits, but can create long-term strength. While others see confusion and uncertainty, Warren sees the seeds of future growth. In every one of these cases, Warren's secret is patience and perspective. He looks beyond the headlines, beyond fear, and beyond the moment. He knows that markets forget, businesses recover, and time rewards those who buy quality when it's unpopular to do so. The lesson is simple yet powerful. When everyone else is running from the storm, Warren walks toward it, because that's where the real treasures are buried. Key lessons. Bad news not equal to bad investment. Often, it's a gift in disguise. The perfect buying moment happens when panic meets potential. Focus on quality businesses, consumer monopolies that can weather storms. Patience plus courage. Profit. Moral of the chapter. When everyone else runs from the storm, walk toward it, because that's where Warren Buffett finds his rainbows. Part 2. Warren Buffett's Intrinsic Value Equations. Chapter 8. Finding the Company and the Numbers. Imagine you're walking through a crowded marketplace. People are rushing toward the shops with the brightest lights, the biggest banners, and the loudest music. Everyone wants what everybody else wants. But then, in a quiet corner, you spot a little shop with no crowd at all. From the outside, it looks ordinary. But inside, the quality is far better, the price unbelievably cheap, and the owner whispers, "People come here only when they know the real value." This is exactly how Warren Buffett shops for companies. He never follows the crowd. He looks for the quiet, ignored, misunderstood businesses whose real value is hidden behind temporary bad news. Now let's walk into that quiet shop together. The story of finding hidden treasure companies. Once you understand what a consumer monopoly is, a business that customers return to again and again because they have no real alternative, the next challenge begins, finding it at a low price. Most people fail here. Why? Because the moment a company posts good news, everyone rushes to buy it. The price shoots up, and the opportunity disappears. Buffett says, "You pay too much when you buy what everyone else loves." And the opposite is also true. You get the best deals when everyone else is scared. So your mission is simple. Look for excellent companies during bad times. Why price matters so much? Some people say, if the company is excellent, the price doesn't matter much. Warren Buffett says, they're dead wrong. To understand why, let's look at Wrigley, the chewing gum company. Imagine two friends. Alan buys Wrigley at $11.80. Roan buys Wrigley at $17.90. 10 years later, the stock is worth $100. Both made money. But look at the difference in their returns. Very simple explanation of compounding return. Compounding return is equal to how fast your money grows every year, step by step. Formula. Rate of return is equal to how much your money multiplies over time, converted into a yearly growth rate. You don't need the formula, just understand that. A small difference in buying price. Huge difference in long-term wealth. Alan's wealth, bought cheap. $100,000 grows to $845,680. Roan's wealth, paid more. $100,000 grows to $555,273. Difference, $290,406 more just because Alan bought at a lower price. Lesson, pay more, earn less. Pay less, earn more. This is why Buffett becomes a hunter of low prices. How Warren tracks companies like a detective. Warren Buffett's brain is like Google for companies. He can recall details about more than 1,000 companies on the NYSE. You and I don't need that kind of memory. We have something better. The Internet. What used to take weeks can now be found in minutes. Here's how you track companies. Buffett style. Step 1. Visit financial websites daily. These sites show which companies are falling, which stocks are being sold heavily, what news caused the drop, the company's financial data, SEC filings, past performance. Examples: MSN Finance, Yahoo Finance, MarketWatch, Morningstar, Investing.com. These sites often have a top losers or what's not hot list. These lists are treasure maps. Step 2. Check the company's website. A good company website gives you annual report, what the company actually does, management discussion, sector outlook, investor presentations, financial statements. This single document tells you whether it's a commodity business or a consumer monopoly. Step 3. Use SEC's Edgar system. Every public company must submit their financial documents here. You can access it for free. It gives 10K annual reports, 10Q quarterly reports, company announcements, insider transactions. For Buffett-style investing, this is pure gold. Step 4. Use Value Line or Library. Buffett has been using Value Line for decades. It gives 15 years of data on more than 1,600 companies. You can find it at your local library for free. The real work, calculating intrinsic value. Once you find a company worth studying, you gather 10 years of financials, balance sheet, income statement, earnings per share, return on equity. Then you calculate: 1. Does it have a consumer monopoly? A powerful brand? Customer loyalty? Unique product? 2. Is it selling at a price that makes business sense? Usually happens when market panic, bad news, temporary problem, economic slowdown, industry trouble. These moments create Buffett-like opportunities. Key points. 1. You can get all the information you need, free, on the Internet. Everything Warren studies is available to you. 2. Start your search with what's not hot. That's where discounts live. 3. Use Edgar for official company filings. Authentic, complete, and always free. 4. The price you pay decides your compounding wealth. Cheap price is equal to more wealth. High price is equal to less wealth. Chapter 9, Financial Calculation 1. Predictability of earnings at a glance. Imagine you're walking into a dimly lit room with a single treasure chest in the center. You open the lid, and instead of gold coins, you find 10 years of a company's earnings. At first it looks boring, just a list of numbers. Nothing shiny, nothing dramatic. But Warren Buffett would smile at this moment, because this is the real treasure. This list of numbers, year after year, tells the story of a business more truthfully than any CEO speech or any glossy advertisement. Buffett knows one thing for sure. If a company's past is unpredictable, its future cannot be trusted. And without trust, an investment is nothing more than a gamble. So today, you'll learn Buffett's first and simplest financial technique, a method so easy that you can do it in under 2 minutes, yet so powerful that it instantly tells you whether a company is worth studying or worth ignoring. Let's begin. The teaching part, understanding predictability. Warren Buffett has one rule before buying any company. If I can't predict the future earnings, even roughly, I don't touch it. But how do you predict future earnings? Here's the secret. You simply look at the past. 10 years, quietly, calmly, carefully. No complicated equations. Just one simple idea. Are the earnings stable and rising? Or are the earnings jumping up and down like a roller coaster? This is Buffett's first filter. If a company fails here, he doesn't even bother going further. The 4 types of earnings patterns. As you look at different companies, you'll mostly find 4 kinds of earnings stories. Steady and rising, excellent consumer monopoly type, wildly unpredictable, avoid commodity type, strong history with sudden weakness, potential opportunity, company in trouble, strong history with a sudden loss, potential opportunity, company in deeper trouble. Let's look at each type like Warren would. Exhibit A, explained like a story. Imagine two friends, Company 1 and Company 2. They both start from humble beginnings, but their journeys look completely different. Company 1, the calm, steady climber. A consumer monopoly-type business. Below is a simple description instead of a table. In 1990, it earned $1.07 per share. In 1991, $1.16. In 1992, $1.28. In 1993, $1.42. In 1994, $1.64. In 1995, a small dip to $1.60. Then rising again, $1.90, $2.39, $2.43, $2.69. Think of this like a calm, steadily growing tree. Each year it grows a little more. Small branches, small corrections, but always rising. In simple words, Company I is predictable. You can roughly imagine what it may earn next year. Buffett loves businesses like this. Company 2, the roller coaster. A commodity-type business. Here's its earnings story. 1990, $1.57. 1991, $0.16. 1992 loss, $1.28. 1993, $0.42. 1994 loss, $0.23. 1995, $0.60. 1996, $1.90. 1997, $2.39. 1998 loss, $0.43. 1999, $0.69. Imagine a car on a dirt road bouncing, shaking, dipping into potholes. That's Company 2. In simple words, you can't predict next year's earnings. It may be high, low, or even a loss. Buffett avoids businesses like this, no matter how attractive they look temporarily. Fast question for you. If you had to bet money on future earnings, which one would you trust? Company I, the slow, steady grower? Company 2, the unpredictable gambler? Exactly. This is the heart of Buffett's first financial test. When bad things happen to good companies, sometimes a previously strong and predictable company hits a rough patch. Buffett does not run away from this situation. He leans in, because this is where fortunes are made. Let's look at two more stories. Company 3, strong past, sudden weakness. Its earnings were rising beautifully for a decade, and suddenly in 1999, earnings fell sharply to $0.48. This is like a strong runner who suddenly trips and slows down. The question is, did the runner lose his legs or just lose balance for a moment? If it's temporary, this could be a golden opportunity. Company 4, strong past, but a sudden loss. This company had excellent earnings for years, and suddenly one year, it shows a loss of $1.69. That's like a champion athlete who suddenly collapses. The key question, is the business fundamentally broken, or is this a fixable injury? Buffett investigates situations like this very deeply because where others see danger, Buffett sees possibility. What you must do as an investor. Just one simple step. Collect 7 to 10 years of earnings per share, EPS. Read them like a story. Is it stable? Is it growing? Or is it chaos? If anything smells confusing or inconsistent, move on. Your job isn't to be a detective for every company. Your job is to find the clear ones. Key points. A 10-year earnings history reveals the true character of a company. Buffett looks for steady, rising earnings. He avoids companies with wild, unpredictable earnings patterns. He is interested in strong companies that have temporary setbacks, not permanent wounds. Predictability is the first doorway. If a company fails here, no need to enter further. Chapter 10. Financial Calculation 2. A test to determine your initial rate of return. The story of the invisible paycheck. Imagine this. You're walking down the street, and someone quietly slips a sealed envelope into your pocket. Inside, it is money you earned, but you never saw anyone hand it to you. Strange, right? Well, that's exactly how Warren Buffett sees company earnings. Every time he buys a stock, he imagines that the company gives him an invisible paycheck, his share of the profits, even if those profits are never deposited into his bank account. Most investors never think this way. But this thinking is the reason Warren became Warren Buffett. The teaching story begins. Warren invests using what he calls the business perspective. He doesn't see stocks as wiggling prices on a screen. He sees them as pieces of a real business, like owning a small portion of a chocolate factory or a newspaper company. So here's how his mind works. If a company earns $5 per share and Warren owns 100 shares, he doesn't wait for the company to send him a dividend check. He simply says, the company earned $5 multiply 100 shares is equal to $500 for me, even if the company keeps all of that money. Why? Because Warren knows this. If a great business reinvests its earnings wisely, the company becomes more valuable, and the stock price eventually follows. This is why Berkshire Hathaway, his company, went from $450 per share in the early 80s to over $54,000 per share without paying a single dividend. The company kept reinvesting its earnings into new opportunities, and the stock price quietly rose, and rose, and rose. The big idea, your initial rate of return. Now comes the important calculation Warren uses to judge whether a stock is cheap or expensive. He asks, how much return am I getting on the money I invest based only on today's earnings? This is called your initial rate of return. Simple formula. Think of it like this. If you invest $100 in a small business, and that business earns $10 for you this very year, your return is 10 divided by 100 is equal to 0.10, 10%. In simple words, rate of return is equal to how much the business earns for you divided by how much you paid. Buffett uses the same idea for stocks. Story of Capital Cities, 1979. In 1979, Capital Cities stock traded at $3.80 per share, earning 0.46 per share that year. To Warren, the question was simple. If I buy one share for $3.80, how much will I earn this year? The answer, rate of return is equal to 0.46 divided by 3.89 is equal to 12.1%. Think of it like buying a machine for $3.80 that prints 0.46 for you every year. That machine is giving a 12.1% yearly return. The Coca-Cola example, 1988. Warren bought Coca-Cola at $5.22 per share. Coke earned 0.36 per share at that time. His brain did the math instantly. Rate of return is equal to 0.36 divided by 5.22 is equal to 6.89%. Not very high compared to capital cities, but Buffett believed Coke's earnings would grow massively, and he was right. The price you pay controls everything. This is where Warren and Ben Graham make their most powerful point. The higher the price you pay, the lower your return. The lower the price you pay, the higher your return. Example, if Warren had paid $10 instead of $5.22 for Coca-Cola, rate of return is equal to 0.36 divided by 10 is equal to 3.6%. Same company, same earnings, just a different price. And that difference nearly cuts his return in half. This is why Warren says, price is what you pay, value is what you get. Key points. 1. Warren treats company earnings as his own earnings. If he owns 100 shares and the company earns $5 per share, he considers he earned $500, even if he receives no dividend. 2. Your initial rate of return depends on the price you pay. Example, if a stock earns $5 per share and you pay $25 per share, rate of return is equal to 5 divided by 25 is equal to 20%. 3. Lower price is equal to higher return. Higher price is equal to lower return. This simple rule is the heart of all great investing. Closing story insight. Think of stocks like buying fruit trees. You don't buy the tree for the price tag on it. You buy it for how many fruits it gives you each year. If 2 trees produce the same fruit, but one costs half the price, you already know which one gives better returns. Warren Buffett simply applies this logic to billion-dollar businesses. And that's the magic. Chapter 11. Financial Calculation 3. The test for determining the per-share growth rate. Imagine this. You're sitting across from Warren Buffett in a quiet Omaha diner. He stirs his Coke with a straw, looks at you, and says with a smile, if a company cannot grow its earnings per share, it cannot grow your wealth. That's as simple as gravity. And just like that, your lesson begins. Today, you learn one of Warren's simplest but most powerful financial tests. the per-share earnings growth rate test. This test tells you whether management is truly making you richer every year, or just pretending. The story behind the lesson. Think of a company as a fruit tree. The per-share earnings, EPS, are the fruits you get every year. If management uses the tree's energy wisely, watering it, pruning it, letting sunshine reach it, the fruit per branch, per share, increases. But if they waste resources or make poor decisions, the fruit shrinks or stops growing altogether. So, Warren created a simple method to check how healthy the tree really is. Why per-share growth rate matters. Earnings growth per share. Predicts long-term stock price appreciation. Shows if management is using retained earnings wisely. Reveals if the business model is getting stronger over time. If per-share earnings grow, shareholder wealth grows. If they don't grow, the business is simply standing still, no matter how big it looks. The simple math behind the test. Warren uses something called annual compounded growth rate, ARG. But don't worry, it's just a fancy way of asking. At what steady yearly percentage did the company grow from the start to the end? You only need 3 things: present value, PV, EPS in the first year. Future value, FV, EPS in the final year. Number of years, N. The time period. The calculator does the rest. Example, Gannett Co., 1990, 2000. Let's walk through the real numbers like a story unfolding. Gannett's EPS over the years looked like this. 1990, $1.18. 1991, $1. 1992, $1.20. 1993, $1.36. 1994, $1.62. 1995, $1.71. 1996, $1.89. 1997, $2.50. 1998, $2.86. 1999, $3.30. 2000, $3.70. Imagine the EPS values like stepping stones that lead you across a river of time from 1990 to 2000. Calculating Gannett's 10-year growth rate, 1990, 2000. PV is equal to 1.18 in 1990. FV is equal to 3.70, 2000. N is equal to 10 years. When you plug these into a financial calculator, like the TI-BA35 Solar, you hit CPT, %I. Result, 12.1% annual growth. This means Gannett increased its earnings per share by about 12% every year for a decade. Calculating the last 5 years, 1995-2000. PV is equal to 1.71, 1995. FV is equal to 3.70, 2000. N is equal to 5 years. Result, 16.6% annual growth. This is higher than the 10-year rate, which tells you something boosted earnings in the last 5 years. Management made smarter decisions recently. The business economics may have improved. Your job is to ask why. Did they repurchase shares? Start a new business segment? Enjoy better advertising income? The numbers are your clues. When earnings suddenly drop, negative EPS situation, sometimes companies face temporary storms, recession, one-time expense, a legal settlement, mismanagement, economic slowdown. Let's look at Company Y and Company 2. In both cases, their long-term earnings were rising beautifully until the final year, 2000, when earnings suddenly collapsed into either low profits or losses. What do we do? If you are confident the issue is temporary, fixable, not deadly to the business model, then Warren simply ignores the problem year. You step back 1 year and use PV is equal to earliest year's EPS, FV is equal to the last normal EPS before the collapse. Example, PV 1989 is equal to 0.95, FV 1999 is equal to 2.70, N is equal to 10 years. Growth rate is equal to 11%. But you must be absolutely sure the business isn't permanently damaged. Warren's rule: never cancel a year unless you're certain the trouble isn't fatal. Study task for you. Pick 5 companies that you believe have strong consumer monopolies. Examples: Coca-Cola, McDonald's, Procter & Gamble, Disney, Apple. Then calculate 10-year EPS growth rate, 5-year EPS growth rate. Use the same steps Warren uses. You can find EPS data at Value Line, Yahoo Finance, MSN Money. Create your own little investing laboratory. Key points. 1. EPS growth is equal to shareholder wealth growth. If per-share earnings rise, stock prices eventually follow. 2. Retained earnings must be productive. Management should use retained earnings to produce more earnings per share, not waste them. 3. Compare long-term versus short-term. A higher 5-year rate than 10-year rate shows recent improvement. A lower 5-year rate signals slowing momentum. 4. Ignore bad years, only when temporary. If an earnings drop is fixable, you may skip the bad year in your calculation, but only with logical justification. Chapter 12, Financial Calculation 4, Relative Value to Treasury Bonds. The day Warren compared apples to gold. Imagine you're walking through a busy market. On one stall, a merchant offers you a shiny gold coin that grows in size every year. On another stall, someone offers you a perfectly safe apple fresh, reliable, but never growing. Which one should you buy? This is exactly the kind of decision investors face every day. And Warren Buffett, he has a simple trick to see which investment gives more for each dollar invested. Welcome to the relative value to treasury bonds calculation, a powerful tool Warren uses to compare any company with the safest investment on earth. The teaching. Why compare to treasury bonds? Warren believes a simple truth. All investments compete for your money, and the safest competitor is the U.S. Treasury bond. Treasury bonds are like the world's safety vault, almost zero risk, but the return is fixed. So the question becomes, if a company wants my money, can it beat the bond? To answer this, Warren does a simple calculation. The formula: relative value is equal to per-share earnings divided by treasury bond rate. Let's break this down in super simple terms. Per-share earnings, EPS, is equal to how much profit each share earned this year. Treasury bond rate is equal to the interest rate paid by government bonds, safe returns. When you divide EPS by the bond rate, you're asking, at what stock price would this company give me the same return as a treasury bond? It's like finding the fair price of the company if it behaved like a bond. Warren Buffett's real example, Capital Cities, 1979. Let's step into Warren's shoes for a moment. Given, per share earnings, EPS, 0.47. Treasury bond rate, 10% or 0.10. Stock price range, 360 to 470. Plug these into the formula. Relative value is equal to 0.47 divided by 0.10. Now imagine dividing 47 cents by 10%. It's like asking, how many dollars would give me the same return? Result: relative value is equal to 470. This means, if you pay $4.70 for the stock, you will get the same 10% return as treasury bonds. But here comes the juicy part. The stock was trading below $4.70. It was between $3.60 and $4.70. That means, if you bought at $3.60, your return would be more than 10%. You beat the bond. And Warren loves beating the bond. But here's the real magic: earnings growth. Capital Cities was growing its earnings at 20% per year. This means the bond gives you a fixed 10%. The company gives more than 10% and grows 20% every year. Now ask yourself, like Warren did, would you rather own a non-growing 10% bond or a fast-growing business giving more than 10%? Easy answer. Capital Cities was the clear winner. A simple visual. Imagine 2 jars. Jar A, treasury bond. You put in $4.70. It gives you a safe fixed 10% every year. But the jar never increases in size. Jar B, Capital Cities stock. You pay less than $4.70, maybe $3.60. It gives you more than 10% return. And the jar grows 20% in size every year. Which jar becomes bigger over time? Jar B, the stock, wins by a landslide. Important clarification, not intrinsic value. Many analysts mistakenly believe EPS divided by bond rate is equal to intrinsic value. But Warren says, no, this only shows value relative to bonds, not true intrinsic value. It's like comparing 2 fruits, good for deciding which to buy, but it doesn't tell you the fruit's full nutritional value. Similarly, discounting future earnings at the Treasury rate also gives value relative to Treasury bonds, not absolute value. A hidden catch, Warren's warning. Treasury bond returns are pre-tax. Corporate earnings, EPS, are after tax, so comparing them directly isn't perfect. Still, it's a useful calculation to keep in your financial toolkit. Key points. 1. All investments compete for your money. 2. Treasury bonds are the safest benchmark. 3. Compare a company's earnings to bond returns using relative value is equal to EPS divided by bond rate. 4. If the stock price is below this value, you're earning more than the bond return. 5. A growing company with returns higher than bonds is often a far better deal. Chapter 13. Financial Calculation 5. Understanding why Warren Buffett loves companies with high return on equity, ROE. Imagine you're standing in a crowded marketplace. 2 shopkeepers call you over. Both shops look identical. Both have the same shelves, same size, same number of workers. But here's the twist. One shopkeeper turns every dollar into gold, while the other barely turns a dollar into copper. You'd obviously choose the shopkeeper who multiplies your money the fastest. That, in simple words, is how Warren Buffett looks at businesses. He wants businesses that turn the shareholders' money into more money, consistently and rapidly. To Buffett, the magic tool that reveals this is return on equity, ROE. Today, we will learn this Buffett secret using stories, simple formulas, and step-by-step reasoning. 1. The concept of the equity and bond, Buffett's mental trick. Buffett says, a stock is like a bond, but with a variable interest rate. Let's decode that. A bond gives you a fixed interest, but a business gives you earnings that change every year. So, Buffett looks at a share of stock like an equity bond where shareholder equity is equal to principal amount. Earnings per share is equal to interest earned. Simple formula. If a company earns 2.5 on shareholder equity of $10, return on equity, ROE, is equal to 2.5 divided by 10 is equal to 25%. For every $10 the company uses, it earns 2.5 profit. That's a 25% return. Buffett loves this because high ROE means your money grows fast. 2. Why ROE matters. A story about a rental house. Let's say you buy a house worth $200,000. You put in your own $50,000. You borrow $150,000. Your equity is equal to $50,000. If rent minus all expenses gives you $5,000 profit, then ROE is equal to $5,000 divided by $50,000 is equal to 10%. You just made a 10% return on your $50,000. This is exactly how Buffett thinks about companies. 3. Company A versus Company B. Same structure, different magic. Imagine 2 businesses standing side by side. Both own $10 million worth of assets. Both carry $4 million in liabilities. That means each company has $6 million of shareholders' equity. On paper, they look like twins. But now comes the moment that reveals the truth. Company A, using that same $6 million of equity, earns $1,980,000 after tax in a year. This means every dollar of equity is working hard, producing a 33% return. Company B, with the same $6 million of equity, earns only $480,000 after tax. Here, the equity produces just an 8% return. Nothing is different in size. Nothing is different in structure. Only one thing is different: how efficiently each company turns shareholders' money into profits. What does this really mean? Company A is multiplying money 4 times faster than Company B. Even though both companies look equal from the outside, their economic engines are completely different. Owning Company A is like planting seeds that grow into a thick forest year after year. Owning Company B is like planting seeds that grow into a few small shrubs, no matter how long you wait. This single difference, return on equity, is why Warren Buffett immediately prefers Company A. Because in the long run, the business that compounds faster always wins. 4. Which one would you own? If you own Company A, you can take a $198 million dividend, or leave the money inside and let management grow it at 33%. Easy choice. Let the compounding continue. If you own Company B, you get only $480,000, and reinvesting gives you only 8%. Not exciting. But here is the magical question. If you could move money from Company B into Company A, what would you do? You'd move it immediately, because 33% beats 8% every day of the week. 5. Buffett's investment logic against treasury bonds. Buffett believes all investments compete with the return from government bonds. If treasury bond interest is equal to 8%, then Company A must be priced such that buying it gives you 8% return. Company B must be priced such that buying it gives 8% return. Let's calculate. Company A price. To generate $198 million at 8%, price is equal to $1.98 million divided by 0.08 is equal to $24.75 million. Company B price. To generate $480K at 8%, price is equal to $480,000 divided by 0.08 is equal to $6 million. Both businesses are priced to give the same 8% first-year return, but their future earnings paths are dramatically different. 6. The magic of compounding. Why a wins big. Now the fun begins. For the next 10 years, Company A compounds at 33%. Company B compounds at 8%. Let's see how their equity grows. Company A's growth, 33% compounding. Year 1, equity, $6 million. By year 11, equity, $103.9 million. Year 11 earnings, $34.29 million. To earn $34.29 million at 8%, someone would need $34.29 million divided by 0.08 is equal to $428 million, Treasury bond equivalent. So, in 10 years, Company A effectively becomes worth $428 million. Your return is equal to 33% annually for 10 years. Company B's growth, 8% compounding. Year 1, equity, $6 million. Year 11, equity, $12.95 million. Year 11 earnings, $136 million. Treasury bond equivalent is equal to $12.95 million. Your return is equal to 8% annually for 10 years. Bingo! 7. Even 25% of Company A beats 100% of Company B. Buffett says, a great business is so powerful, even a small slice of it beats full ownership of a mediocre business. If you bought 100% of B for $6 million grows to $12.95 million. 25% of A for $6.1875 million grows to $107 million multiplied by 25% is equal to $26.75 million. Which is better? Clearly 25% of A. 8. Buffett's genius. Why paying a high PE for a high RO business makes sense. At first glance, Warren Buffett often looks reckless. He willingly pays what others call too expensive prices for certain businesses. High price-to-earnings ratios, premium valuations, numbers that scare away most investors. But Buffett sees something deeper. Let's go back to Company A, the business that can consistently earn 33% on its shareholders' equity. Scenario 1. Buying at a reasonable price. Suppose you buy Company A for 12.5 times its earnings, which comes to about $24.75 million. You hold it for 10 years. Because the business compounds at 33% annually, your investment also compounds at roughly 33% per year. That is extraordinary. Scenario 2. Paying what looks like an expensive price. Now imagine you pay a much higher price. 30 times earnings, or roughly $59.4 million. Many investors would immediately walk away, saying, that's far too expensive. Yet, if the business continues earning and reinvesting at 33%, and you sell it 10 years later at a normal valuation, your money still compounds at about 21.8% per year. That's not just good. That's exceptional. Scenario 3. paying an even higher price. Now push it further. Suppose you pay 40 times earnings, or about $79.2 million. That sounds outrageous. And yet, even in this case, your investment still compounds at approximately 18.3% annually over 10 years. Most professional fund managers never achieve this level of return. The big insight. Even the worst of these outcomes, 18.3% per year, is still an outstanding long-term result. This is the secret most investors miss. A great business can bail you out of a high purchase price. A mediocre business cannot save you, no matter how cheap it looks. That is why Buffett famously says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." He knows that when a company earns very high returns on equity, time and compounding do most of the heavy lifting, even if you pay up front. 9. Real-life proof, Coca-Cola, 1988 to 2000. Coca-Cola's ROE was consistently near 33%. If you invested $100,000 in 1988, in 12 years, it became $1,100,000. Annual return, 22%. With dividends, 23%. A 23% annual compounding over 12 years. From a soft drink. That is the power of consumer monopoly plus high ROE plus time. No magic, just math and discipline. Key points. 1. Buffett sees a stock like an equity and bond. Earnings per share is equal to the bond's yield. 2. High ROE is equal to your money grows faster every year. Low ROE is equal to slow, painful growth. 3. Compounding magnifies differences drastically over time. 33% versus 8% becomes $428 million versus $1,295 million after 10 years. 4. Even paying a high PE is fine if ROE is consistently high. 5. Buffett's favorite companies. Consumer monopoly. High ROE. Strong, predictable earnings. Able to reinvest profits at high rates. Chapter 14. Financial Calculation 6. The secret of projecting your annual compounding rate of return. A story to enter the world of Warren. Imagine you're standing outside a huge vault. A vault filled with wealth that could grow and compound for decades. The vault has only one rule. You can open it only if you know how fast what's inside will grow every year. This is the game Warren Buffett plays every single time he buys a stock. He doesn't just ask, "Is this company good? Is the news bad enough to make it cheap?" He asks the ultimate question. "If I buy this today, how much will my money grow every year for the next 10 years? If the answer is great, he buys. If the answer is mediocre, he walks away. He lets the math decide. And that's why he rarely loses. Today, you'll learn how Warren calculates this magical number, the projected annual compounding rate of return, in the simplest, most story-like way. Why this number matters so much. Think of Warren like an archer. Bad news in markets is the wind that pushes the price down. But the projected rate of return is the moment he decides. Now the target is close. Take the shot. High projected rate. Price is cheap. He buys. Low projected rate. Price is expensive. He waits. This one number is the compass guiding almost every major decision he makes. A simple way to think about intrinsic value. Warren defines intrinsic value as all the money a business will earn in the future brought back to today's value. But that's impossible to calculate for 50 or 100 years. Why? Because businesses change. Industries die. Technology disrupts. Television once looked like an unbeatable monopoly. Just like Venice once controlled the spice trade, until the Dutch ships arrived. Nothing stays the same forever. So instead of trying to predict 100 years, Warren predicts only 10 years ahead. 10 years is long enough to show a trend, but short enough that the business remains recognizable. Warren's practical 10-year method. Here is Warren's simple and genius approach. 1. Find today's shareholders' equity per share. Think of it as the company's wealth factory per share. 2. Find how fast this equity historically grows. Return on equity, ROE, minus dividends paid. 3. Project that equity 10 years into the future. 4. Estimate future earnings using future equity multiplied by future ROE. 5. Estimate the stock's future trading value, usually around its future equity value. 6. Compare what you will pay today versus what it will be worth in 10 years. 7. Let the calculator tell you your yearly return. If this compounding return is high, buy. If low, wait. Why this works? Because price determines your return. Pay more, you will earn less. Pay less, you will earn more. The business grows at its own natural speed, but your profit comes from the price you pay today. Let's learn using a real story. Berkshire Hathaway in 1986. Imagine we're in 1986. Berkshire Hathaway has shareholders' equity, $2,073 per share. Historical ROE growth, 23.3% per year. Years to project, 14 to year 2000. How do we find what this $2,073 grows to? Understanding the formula, future value is equal to present value multiplied by 1 plus growth rate years. Very simple idea. Your money grows a little. Then the next year, it grows on the new, bigger amount. And this keeps repeating. That is compounding. When we apply it, $2,073 growing at 23.3% for 14 years becomes $38,911 of equity per share in 2000. That's how much Wealth Factory one Berkshire share would have. Next step, should we buy? Now imagine you want 15% average yearly returns. How much should you pay in 1986 for something that becomes $38,911? In 2000? This is the reverse of compounding. The reverse formula is present value is equal to future value divided by 1 plus rate years. Meaning, how much should I pay today to grow to that future amount at my desired rate? After calculating, if you want 15% yearly return, you should pay no more than $5,499 per share. But the market price in 1986 was only $2,700. That's far below the maximum fair price. So what does Warren do? He buys happily. What if you bought a share at $2,700? Let's see how much you earned from 1986 to 1999. In 1999, Berkshire traded between low $50,000, high $81,000. Let's calculate the return. If you bought at $2,700, sold at $81,000, your yearly return is equal to 29.9% per year. If you sold at $50,000, your yearly return is equal to 25% per year. That's the magic of buying low and waiting. Now let's try the opposite. What if you paid a high price? Say you bought in 1999 at $81,000 per share, and the company keeps growing at 23% per year. Projected 2009 equity value, a massive $293,239. Now calculate return. Buy at $81,000. Sell at $293,239. After 10 years, return is equal to 13.7% per year. Not bad, but far below the earlier 25% to 30% returns. Again, price controls your destiny. If growth slows down, if Berkshire grows at only 15%, 1999 equity is equal to $37,000. 2009 projected equity is equal to $149,685. Now calculate return. Buy at $81,000. Earn only 6.3% per year. Buy at $50,000. Earn 11.5% per year. The lesson keeps repeating. Buy low, your return explodes. Buy high, your return shrinks. A small bonus. What if the market pays double the equity value? Sometimes Berkshire trades at 2 multiplied by its equity value. So if 2009 equity is $293,239, the market price might be $586,478. If you bought at the low, $50,000, and sold at this higher price, your return is equal to 27.9% per year. But this is the absolute best-case scenario. Key lessons. 1. You cannot predict 50 to 100 years of earnings. Too many variables. Impossible. 2. You can predict roughly 10 years ahead. And that is enough to make fortunes. 3. The price you pay sets your return. Pay low, earn high. Pay high, earn low. 4. The projected annual compounding rate of return is the compass of intelligent investing. If it's attractive, buy. If not, wait. Chapter 15. Determining the projected annual compounding rate of return. A story of Warren Buffett, Coca-Cola, and the magic of predictable growth. Imagine someone walking up to you and offering a 12-year bond from a legendary company. A bond that guarantees 14%, 18%, even 22% return per year, tax-free. You'd probably think they're crazy. But here's the twist. Warren Buffett actually bought something like this. Not a bond, but Coca-Cola stock in 1988. In this chapter, you'll learn how Warren looked at Coca-Cola not as a stock, but as a supercharged compounding machine, and how he calculated that his return could be enormous long before the world saw it. Let's step into the story. Coca-Cola, 1988. It's 1988. Warren is examining Coca-Cola, a giant, a brand loved across every continent. But Warren doesn't care about popularity. He cares about numbers. He sees Coca-Cola not as stock, but as a bond with a growing coupon. So he buys 113,380,000 shares at $5.22 each, investing around $592 million. Now the interesting part, Coca-Cola at that time had shareholders' equity per share, $1.07, earnings per share, $0.36. So Warren's equity bond had a $1.07 principal, earning $0.36 per year. How Warren thinks. Return on equity, ROE. Formula. Return on equity, ROE, is equal to earnings per share divided by equity per share, is equal to $0.36 divided by $1.07, is equal to 33.6%. This means every $1 of equity inside Coca-Cola produced 33.6 cents of profit per year. That's insanely high. Warren loves companies that can take $1 and reliably turn it into $1.33 next year. Coca-Cola's earnings split. 2 different yields. Coke used its earnings in 2 ways. 58% retained, stays inside the company to grow. 42% paid out as dividends. Let's simplify. Total earnings, $0.36. Retained earnings, 58%, $0.21. Dividend paid, 42%, $0.15. Think of Coke telling Warren, "For every share you bought, we'll pay you 15 cents in cash, and we'll reinvest 21 cents for you, tax-free, inside the company to grow even more." This is the magic engine. How Coca-Cola's equity grows. Each year, Coca-Cola increases its equity by the retained portion. Simple formula. New equity value is equal to old equity, multiplied by 1 plus retained ROE growth. Retained ROE growth is equal to 33.6% multiplied by 58% is equal to 19.4%. So, year 1988, equity is equal to $1.07. 1989, equity is equal to $1.07. Multiply by 1.194 is equal to $1.27. Every year, Coca-Cola's equity base grows at 19.4% because of the portion reinvested. That's like planting a mango seed today and having a mango tree next year. Projecting future earnings. Once you know next year's equity, earnings are simple. Earnings is equal to equity multiplied by ROE, 33.6%. Example, 1989. Equity is equal to $1.27. 1989 earnings is equal to $1.27. Multiply by 0.336 is equal to $0.43. Do this for each year, and you can project earnings far into the future. Table AA explained in simple words. The table from 1988-2000 tracks 4 things. Equity per share grows by 19.4% annually. Earnings per share, 33.6% of equity. Dividends, 42% of earnings. Retained earnings, 58% of earnings. What you need to understand, equity keeps growing. Earnings keep rising. Dividends keep increasing. Everything compounds like a snowball rolling downhill. By year 2000, projected earnings per share become $3.02. Remember, they were $0.36 in 1988. That's almost 10x growth in earnings over 12 years. Predicting Coca-Cola's future stock price. Once we know earnings, we can estimate price. Simple formula. Future stock price is equal to earnings, multiply by P/E ratio. The book uses a conservative P/E of 15. $3.02 multiplied by 15 is equal to $45.30 per share. A more optimistic P/E of 25 gives $3.02 multiplied by 25 is equal to $75.50. What Warren saw in 1988, he paid $5.22 per share. He projected, low case, $45.30 by 2000, 19.7% annual return. High case, $75.50 by 2000, 24.9% annual return. Even after taxes and adjustments, returns remained extremely attractive. After tax, 17.8% at P/E 15. After tax, 22% at P/E 25. Even a terrible case P/E of 9 still gave 14.4% return. It was like buying a bond with guaranteed high returns. Why the magic worked? The true hero behind all the numbers is Coca-Cola's consumer monopoly. This monopoly allowed constant high ROA, constant reinvestment, predictable compounding, shareholders getting richer every year, even during temporary setbacks, Asia recession, Belgium incident, restructuring. Coca-Cola's long-term engine kept running, and the market eventually rewarded it, pushing the P/E to 40 to 50, even above Warren's conservative expectations. Actual versus projected earnings, 1989 to 1999, the comparison table shows. For 9 years, Coca-Cola's actual earnings stayed within 0 to 8% of projections. Only in 1998 to 1999 did results diverge sharply due to global issues. This proves something incredibly rare. Some businesses are predictable, very predictable, especially strong consumer monopolies. Final outcome. By 2000, Warren's 1988 investment of $592 million turned into $6.23 billion. That's a pre-tax compounded return of 21.6% per year. That's the power of buying a compounding machine and holding. Key points. 1. Future earnings of strong monopolies can be predicted with surprising accuracy. Coca-Cola is the perfect example. 2. When projecting future stock price, always use the average P/E of the last 10 years. Avoid optimistic P/E ratios. They mislead. 3. The real engine of wealth is high ROE plus retained earnings. When a company reinvests at high returns, the compounding becomes explosive. Chapter 16, Financial Calculation 7. The Equity Bond with an Expanding Coupon. Imagine walking into a magical bank. At the entrance, the guard tells you, "Sir, the interest rate for entering is low, but once you're inside, the interest grows every single year, faster and faster." This sounds impossible, right? But this is exactly how Warren Buffett views certain companies. To Warren, some stocks behave like bonds, but with one special twist. Instead of paying you the same interest every year, the interest grows. Welcome to the world of the equity bond with an expanding coupon. A story behind the coupon idea. Before the world became digital, old-fashioned paper bonds came with small paper coupons attached. Each year you would 1. Cut out a coupon. 2. Mail it to the issuer. 3. Receive your fixed interest payment. This interest coupon never changed. A 5% bond always paid 5%. But Warren's mind works differently. He imagined certain stocks as equity bonds where you buy a share, like buying a bond. The company earns money, your interest. But this interest, earnings, grows each year. The expanding coupon, Warren's Coca-Cola investment, a perfect example. Let's travel back to 1988 when Warren bought Coca-Cola, KO. The numbers in 1988. Earnings per share, EPS, $0.36. Shareholders' equity per share, $1.07. Return on equity, earnings divided by equity, is equal to 0.36. 0.36 divided by 1.07 is equal to 33.6%. This means Coca-Cola earned 33.6% on each dollar of equity. Warren's first insight: what you pay determines your return. Here's the twist. If you had paid $1.07 for a Coke share, you'd earn 0.36 divided by 1.07 is equal to 33.6%. But Warren didn't pay $1.07. He paid $5.22 per share. So his first-year return is 0.36 divided by 5.22 is equal to 6.89%. Simple explanation: you paid more, your return drops. Just like buying a rental property at a higher price reduces your yield. So Warren's initial coupon is equal to 6.89%. Not great, but Warren wasn't buying Coke for 1 year. He was buying it because he believed something magical. Coca-Cola's earnings would grow every year, and so would his rate of return. The magic of retained earnings. This is where the expanding coupon begins. Coca-Cola retained 58% of its earnings to reinvest back into the business. 1988 retained earnings. 58% of $0.36 is equal to $0.21. This $0.21 is added to Warren's equity bond. What does this mean? Warren now has more capital working for him without paying anything extra. Warren's total investment going into 1989. At the start of 1989, Warren's investment in Coca-Cola is made up of two parts. First, there is his original investment from 1988, which is $5.22 per share. This is the money he initially paid to buy the stock. Second, Coca-Cola retained $0.21 per share from the 1988 earnings and reinvested it back into the business. Even though this money comes from profits, it now becomes additional capital working for Warren, just like extra money he put in himself. When we add these two together, original 1988 investment, $5.22, plus retained earnings from 1988, $0.21. Warren's total investment going into 1989 becomes $5.43 per share. Think of it as planting a tree for $5.22, and during the year, the tree grows a new branch worth $0.21 without you paying anything extra. Now, the whole tree worth $5.43 is ready to produce even more fruit in the next year. How much will this $5.43 earn in 1989? Break it into two parts. 1. Original investment, $5.22, still earns the original 6.89%. 5.22 multiplied by 6.89% is equal to 0.36. 2. Retained earnings from 1988, $0.21. These earn Coca-Cola's ROE of 33.6%. 0.21 multiplied by 33.6% is equal to 0.07. Total, 1989 earnings is equal to 0. 0.36 plus 0.07 is equal to $0.43. Now calculate rate of return. 0.43 divided by 5.43 is equal to 7.9%. His coupon is no longer 6.89%. It has expanded to 7.9%. The expansion continues in 1990. By the end of 1989, Coca-Cola has earned $0.43 per share. Just like before, the company does not distribute all of this money. Instead, it keeps 58% of the earnings and reinvests it back into the business. So the retained portion is calculated like this. $0.43 multiplied by 58% is equal to $0.25 per share. This $0.25 is not something Warren pays from his pocket. It is money his investment generated and then quietly put back to work inside Coca-Cola. Now let's see how much total capital Warren has invested as he enters 1990. His original 1988 investment is still $5.22 per share. From 1988, Coca-Cola had already retained $0.21 per share. From 1989, it retains an additional $0.25 per share. When we add the retained earnings together, $0.21 plus $0.25 is equal to $0.46. Now add this to the original investment, $5.22 plus $0.46 is equal to $5.68. So, at the beginning of 1990, Warren effectively has $5.68 per share invested in Coca-Cola. Think of it like this. Warren planted a seed worth $5.22. Over 2 years, the tree kept reinvesting its own fruit back into itself, growing stronger and larger. By 1990, that same tree is now worth $5.68, and it's ready to produce even more fruit than ever before. Earnings for 1990. Break again. 1. Original $5.22. 6.89% is equal to $0.36. 2. Retained earnings. $0.46. 33.6% is equal to $0.15. Total earnings is equal to 0.36 plus 0.15 is equal to $0.51. Rate of return. 0.51 divided by 5.68 is equal to 8.9%. The coupon has expanded again. 1988, 6.89%. 1989, 7.9%. 1990, 8.9%. It keeps rising, year after year. The beauty of Buffett's logic. Warren's view. Your initial return is small because the stock seems expensive. But the retained earnings you don't pay for earn at full power, the company's ROE. Think of it like this. You buy a bond that pays 6.89%. Every year, the bond pays an interest check. Instead of spending it, you reinvest that interest into a new bond paying 33.6%. This is why Warren said, "You pay a steep price to get in the door, but once you're in, it's heaven." Key points. 1. Warren views stocks as equity-turned bonds with expanding coupons. 2. What you pay controls your initial return. Pay more, your first-year return drops. 3. Retained earnings are the engine of wealth. They earn the company's ROE, Coca-Cola, 33.6%. 4. Over time, your coupon expands from 6.89%, 7.9%, 8.9%, and keeps going. 5. This is the secret behind Buffett's long-term compounding power. Chapter 17 Financial Calculation 8. Using the per-share earnings, growth rate to project an investment's future return. Imagine you're sitting across from Warren Buffett at a small cafe in Omaha. He's stirring his Coca-Cola with a straw, smiling and says, "If you know how fast a company grows its earnings, you can look into the future." You lean forward. The idea sounds magical, like predicting where a river will flow just by watching how the water moves today. And that's exactly what Warren does. He doesn't chase stock tips. He doesn't wait for Wall Street to whisper secrets. He simply studies earnings growth, then uses it to project the future price, and therefore the future return on his investment. Today, you'll learn this same skill. Let's begin. Part 1. Projecting Future Earnings, a Story of Capital Cities. Between 1970 and 1980, Capital Cities was quietly becoming a powerhouse. In 1970, it earned $0.08 per share. In 1980, it earned $0.53 per share. This rise wasn't random. It was steady, predictable, powerful. This 10-year journey equals a 20% annual compounding growth in earnings. Now imagine it's 1980. You're an investor holding a $5 bill. You're thinking, if I buy Capital Cities today, what might it be worth in 1990? Warren's method gives you the answer. Step 1. Project earnings, 10 years into the future, 1980 to 1990. The formula. Future earnings is equal to present earnings. Multiply by 1 plus growth rate. To the power n, where present earnings is equal to $0.53. Growth rate is equal to 20%, is equal to 0.20. N is equal to 10 years. Think of it like planting a mango seed. Each year it grows 20% taller. After 10 years, it is much larger naturally. Using the formula, future earnings become $3.28 per share, projected for 1990. That's your first big insight. Part 2. Projecting the stock price in 1990. Now that you know the earnings for 1990, you ask, what price will the market pay for these earnings? To answer this, we look at the P/E ratio. Quick explanation of P/E ratio. P is equal to price. E is equal to earnings. P/E is equal to how many dollars investors are willing to pay for each dollar of earnings. Between 1970 to 1980, capital cities traded at P/E values from 9 to 25. To stay safe and conservative, like President Reagan, Buffett chooses the lowest. P/E is equal to 9. Projected price, simple math. Price is equal to earnings. Multiply by P/E. Price is equal to $3.28. Multiply by 9. Price is equal to $29.52. So, in 1980, you could reasonably predict capital cities stock may trade around $29.52 in 1990. Part 3. Calculating your expected return, 1980 to 1990. In 1980, the stock price was about $5. Now we know PV multiplied by price you pay is equal to $5. FV multiplied by future price is equal to $29.52. Years is equal to 10. The formula, your return is simply the interest rate that turns $5 into $29.52 over 10 years. When you plug these into a financial calculator, you get 19.4% expected annual compounding return. This means, if you bought at $5 in 1980, you could expect almost 20% per year for 10 years. Part 4. What actually happened in real life. Here's where the story gets exciting. Real earnings in 1990. Actual EPS is equal to $2.77, lower than our projected $3.28. Real stock price in 1990, it traded between $38 and $63. This is much higher than our predicted $29.52. Even if you sold at the low end, $38, your actual return becomes PV is equal to $5. FV is equal to $38 in 10 years. Return is equal to 22.4% per year. If you sold near the high of $63, return is equal to 28.8% per year. That's extraordinary. A real-life example. If you invested $100,000 at $5 per share, after 10 years at 22.4% return, your money becomes $754,769.21, over 7 times your capital. The big lesson, Warren's true magic. Warren Buffett is not saying, this stock is worth X today. Instead, he asks, if I buy this business at today's price, what return will I earn over the next 10 years? This is a powerful shift in thinking. You stop caring about daily prices. You stop reacting to market noise. You start thinking like an owner, not a trader, and the market eventually rewards that mindset. Key takeaways. 1. Future price can be projected using earnings growth. If a company has a durable competitive advantage, its growth rate is stable enough to predict. 2. Warren does not calculate exact value. He estimates future returns, not today's fair value. 3. His main question? If I pay X today, what return will I get in 10 years? 4. He compares this return to alternatives. Treasury bonds, other stocks, inflation, etc. 5. He doesn't watch stock quotes daily. Long-term earnings growth eventually forces the price upward. Just like a rising tide eventually lifts every boat tied to the shore. Chapter 18. Financial Calculation 9. Why Warren Loves Stock Repurchase Programs. Imagine you own a pizza shop with 9 friends. The pizza is cut into 10 slices. Each slice representing one owner's share. Now one day, the shop earns extra cash. Instead of handing everyone a tiny amount of money, the shop decides to buy back one slice from one friend. What happens now? There are only 9 slices left, but you still hold your original slice. Suddenly, your slice is bigger, not because the pizza grew, but because there are fewer slices dividing it. This simple idea, shrinking the number of slices, is one of Warren Buffett's favorite wealth-building secrets. Let's dive into how Buffett uses this quiet but powerful trick to grow fortunes. The story: How buybacks make Warren richer without new investment. Once Warren invests in a wonderful business, a consumer monopoly with rising earnings, he starts friendly lobbying. He leans over to the board of directors and says, "If the stock is reasonably priced, consider buying back your own shares. Trust me, your loyal long-term shareholders will thank you." Why? Because when a company buys back its shares, something magical happens. Total company value stays the same. Number of shares decreases. Each remaining share becomes more valuable. And best of all, Warren doesn't have to invest another penny, yet his ownership increases. Simple example to understand the magic. Situation: Company has 100 million shares. Warren owns 10 million shares is equal to 10% ownership. Now the company goes into the market and buys back 40 million shares. After buyback, shares outstanding, 60 million. Warren still owns 10 million shares. New ownership percentage. Formula: new ownership percent is equal to shares. Warren owns divided by total shares after buyback. So, 10 million divided by 60 million is equal to 16.6%. Warren's ownership jumps from 10%, 16.6%, without investing anything. The company spent its own cash to increase Warren's stake. Why buybacks beat dividends? If instead the company paid that buyback money as a dividend, Warren would receive cash, but he'd pay about 30% tax, which means less money to reinvest. Buybacks avoid this tax and increase ownership silently. Buffett loves efficiency, and buybacks are tax-efficient wealth builders. The Washington Post story: a real-life win. When Berkshire bought into the Washington Post, it purchased 10% of the company for $10.2 million. Years later, because of continuous buybacks, Berkshire's ownership rose to 17.2%, without buying more shares. Market value calculation: Washington Post today, as given, 10.04 million shares, trading at $500. Market capitalization: 10.04 million multiplied by 500 is equal to $5.02 billion. Without buybacks, 10% multiplied by 5.02 is equal to $502 million. With buybacks, 17.2% multiplied by 5.02 is equal to $863.4 million. Extra wealth from buybacks: 863.4 minus 502 is equal to $334.4 million. Buffett made $334.4 million more just because the company repurchased shares. No extra investing, no extra risk, just smart capital allocation. The Geico story: an even bigger win. In 1980, Berkshire bought 33% of Geico for $45.7 million. Through continuous buybacks, Berkshire's ownership rose to 50% by 1995. Market value in 1995 is equal to $4.7 billion. 33% value is equal to $1.55 billion. 50% value is equal to $2.35 billion. Extra wealth created by Geico buybacks: 2.35 minus 1.55 is equal to $800 million. Again, Buffett invested nothing extra, yet gained $800 million more thanks to the shrinking share count. The business economics of buybacks: Coca-Cola case study. Now let's see how buybacks increase. Earnings per share, EPS. Share price, return on equity, shareholder wealth. Coca-Cola buybacks, 1984 to 1993. Shares in 1984, 3.174 billion. Shares in 1993, 2.604 billion. Reduction: 570 million shares is equal to 21%. Coca-Cola spent $5.8 billion buying back these shares. Cost per share retired, 5.8 billion divided by 3.174 billion is equal to $1.82 per share. This means Coke spent $1.82 of shareholders' money per share to reduce the share count. EPS comparison with versus without buybacks 1993. Given 1993, net income is equal to $2.176 billion. EPS with repurchases. 2.176 billion divided by 2.604 billion shares is equal to 0.84. EPS without repurchases. 2.176 billion divided by 3.174 billion shares is equal to 0.68. Increase in EPS due to buybacks. 0.84 minus 0.68 is equal to 0.16. Buybacks increased EPS by $0.16 per share. Simple chart in words. Imagine two bars. Bar 1, no buybacks. EPS is equal to $0.68. Bar 2, with buybacks. EPS is equal to $0.84. Bar 2 is taller. This taller bar makes the stock more valuable. How the market rewards buybacks. Market PE is equal to 25x. Without buybacks, 0.68 multiplied by 25 is equal to 17. With buybacks, 0.84 multiplied by 25 is equal to 21. Increase in share price. 21 minus 17 is equal to 4. So spending $1.82 per share created $4 of market value. That's more than double the money. Brilliant capital allocation. Long-term power. The 2003 hypothetical scenario. Assume earnings grow 15% per year. By 2003, earnings is equal to $8.403 billion. 2003 EPS with no repurchases. 8.403 billion divided by 3.174 billion is equal to 2.65. 2003 EPS with repurchases. 8.403 billion divided by 2.604 billion is equal to 3.23. Market price at PE 25. Without buybacks, 2.65 multiplied by 25 is equal to 66.25. With buybacks, 3.23 multiplied by 25 is equal to 80.75. Extra value created is equal to $14.50 per share, all from spending $1.87 per share for repurchases. This is an approx. 15% annual compounding return without shareholders doing anything. Berkshire's ownership increase in Coca-Cola. Berkshire bought 7.8% of Coke, 1987 to 1994. Coke reduced shares from 2.551 billion, 2.460 billion, 1994 to 1999. This automatically increased Berkshire's stake to 8.13%. Market cap in 1999 is equal to $135.3 billion. Extra value Berkshire gained $135.3 billion multiplied by 0.0033 is equal to $444.49 million. Again, no extra investment, just intelligent compounding. Key points. 1. Buybacks make your share of the company larger. The pie stays the same, but fewer slices mean your slice grows. 2. Buybacks boost EPS. Earnings stay the same, fewer shares, higher earnings per share. 3. Higher EPS is equal to higher stock price. Market rewards growing earnings per share. 4. Shareholders avoid dividend taxes. Cash stays inside the business and compounds instead of leaking to taxes. 5. Buybacks can make sense even at high stock prices. If the company can reinvest cash at a good return, buybacks amplify value. 6. Buffett loves them because they increase his ownership automatically. Buybacks are silent compounding machines. Chapter 19, Financial Calculation 10. How to determine if per-share earnings are increasing. Because of share repurchases. Imagine you are watching a magic show. The magician waves his hand, says a few fancy words, and suddenly a coin appears behind your ear. Everyone claps, but you know deep inside that this is not real magic. It's just technique. Corporate earnings sometimes work exactly like that. A company can make it look like profits per share are growing, even when the actual business is struggling. And the trick behind this magic? Share repurchases. Today, let's become the audience member who doesn't get fooled by illusions, the one who knows where the magician hides the coin. The core idea: before you invest, you must know why a company's per-share earnings are increasing. Is it because 1. The business engine is growing? Profits are truly rising. Or 2. The company is just shrinking its share count? A financial trick raising EPS without real improvement. To separate real growth from financial mechanics, Warren Buffett compares actual net earnings growth rate and per-share earnings growth rate. If EPS grows faster than net earnings, share repurchases are influencing the numbers. Teaching with examples. The simple formula: per-share earnings, EPS. EPS is equal to net earnings divided by shares outstanding. In super simple words, you take the company's total profit and divide it into pieces. More shares is equal to more slices, is equal to smaller piece per share. Fewer shares is equal to fewer slices, is equal to bigger piece per share. Example 1. The Gillette magic trick. Gillette's net earnings in 1999, net earnings $1,265 million. Shares outstanding $1,095 million. EPS $1.15. You get this by 1,265 divided by 1,095 is equal to 1.15. Now imagine Gillette buys back shares and reduces them to 800 million. 1,265 divided by 800 is equal to 1.58. EPS jumps from $1.15 $1.58, even though profits did not increase at all. That's the magic trick. But if Gillette had more shares, say 1,500 million, EPS drops. 1,265 divided by 1,500 is equal to 0.84. Example 2. Company X, the illusion of growth. Let's walk into the story of a company over 10 years. 1990, net earnings $100 million. Shares, 10 million. EPS, 100 divided by 10 is equal to 10. So EPS is equal to $10. 2000. But business got worse. Net earnings dropped to $75 million. Shares reduced to 5 million because of buybacks. EPS now, 75 divided by 5 is equal to 15. Even though profits fell, EPS went from $10, $15. EPS appears to grow. Annual EPS growth rate. EPS grew from 10 to 15 over 10 years. That's a 4.13% annual growth rate. Actual net earnings growth rate. $100 million. $75 million is a decline. That is 2.83% annually. The hidden truth. EPS is rising, but the business is shrinking. Management may proudly say, EPS grew 4.13% last year. But that growth comes only from reducing shares, not from better business performance. This is how mediocre results hide behind buybacks. Example 3. When shares increase instead. Now imagine a different situation. A company needs extra money to grow. So instead of buying back shares, it issues new shares. That means the ownership pie now has more slices. Let's see what happens. The company earns $10 million in total profit. First, it has 100 million shares outstanding. To find per-share earnings, we divide. $10 million divided by 100 million shares is equal to $0.10 per share. Each shareholder gets a slice worth 10 cents. Now the company issues more shares to raise money. The total shares become 125 million. But notice, net earnings are still $10 million. So we divide again. $10 million divided by 125 million shares is equal to $0.08 per share. Now each slice is smaller. EPS falls from $0.10 $0.08, even though the company's total profit did not change at all. The simple lesson: when shares increase, the profit must be divided into more pieces. So each piece becomes smaller. More shares, smaller slice, lower EPS. And once again, net earnings stayed the same. Only the number of shares changed. Yet EPS moved, purely because of financial mechanics. This is why a smart investor always checks. Did profits really grow, or did the share count change? Summary: share repurchases can increase EPS even when net earnings stay flat. Increase EPS even when net earnings fall. Sometimes improve the economics of the company. Sometimes disguise weak performance. Increase your ownership in the business without you buying more. But they are not a replacement for true business strength. Real sustainable growth comes from strong economic engines, consumer monopolies, durable competitive advantages, not from accounting mechanics. Key lessons you should never forget. 1. Always compare net earnings growth with per-share earnings growth. If EPS grows faster, buybacks are at work. 2. Buybacks are powerful, but only when the business already has strong economics. 3. Buybacks can mislead you if you don't check whether profits are actually growing. 4. The true strength of a business is shown in actual net earnings, not EPS tricks. Chapter 20, Financial Calculation 11. How to measure management's ability to utilize retained earnings. Imagine you own a small shop that suddenly makes a big profit one year. You're holding the money in your hands, smiling. But then reality taps you on the shoulder. Your freezer will break next year. Your shelves need replacement. Your machine is aging. Now the big question hits you. Should you keep this money and reinvest it, or hand it over to your family, your shareholders, to use however they want? This is exactly the dilemma every company faces. And the way management handles this money separates an average company from a wealth compounding machine. Warren Buffett became a billionaire largely because he mastered one powerful idea. How well a company uses its retained earnings determines how rich shareholders will become. Today, you'll learn exactly how to measure this skill with a simple math trick that even Warren loves. The story behind retained earnings. When a company earns profit, it faces two choices. 1. Use part of the profit to maintain the business. This is restricted earnings, money that must be used to keep the business alive. Example: if Company A earns $1 million but needs $400,000 to replace a generator, then $400,000 restricted must be spent to survive. $600,000 unrestricted, free to use. 2. Decide what to do with the unrestricted part. Management has two choices: pay it to shareholders as dividends or reinvest it in new projects or growth. Buffett focuses only on this unrestricted piece because that's what determines growth, shareholder returns, and stock price performance. Buffett's golden rule: a company should retain earnings only if it can earn a higher return than shareholders could earn on their own. Example: if management can reinvest at 15%, but shareholders could only earn 8 to 10% elsewhere, keep the money. If reversed, if shareholders can earn 15%, but management can reinvest only at 5%, pay dividends instead. Simple, logical, powerful. The trouble: how do we judge management? This is the tricky part. A company with a great business model can generate so much cash that even mediocre managers look brilliant. Example: a company with strong pricing power may grow earnings simply because of inflation, not smart decisions. Weak businesses hide capital allocation mistakes because they always need more money to operate. So how do we separate skilled capital allocators from lucky ones writing good businesses? Buffett uses a beautifully simple test. The simple formula: we measure how much earnings per share EPS management retained over a period, and how much EPS increased during the same period. Then we ask, how much return did management earn on each dollar they kept? The formula: return on retained earnings is equal to increase in EPS divided by total retained EPS. Return on retained earnings, total retained EPS, increase in EPS. Explained simply, take all the earnings the company kept, not paid as dividends. See how much EPS grew because of it. Divide growth by retained part. That's management's true skill score. Example 1, Gillette, the superstar. Let's walk through it step by step. Step 1, starting point, 1989. Gillette EPS is equal to $0.34. This represents everything the company had built up to 1989. Step 2, total earnings from 1989 to 1999. Earned $8.67 per share. Paid dividends $3.11 per share. Retained $8.67 minus $3.11 is equal to $5.56. So Gillette kept $5.56 per share to reinvest. Step 3, EPS in 1999. EPS grew from $0.34, $1.15. Increase is equal to 1.15 minus 0.34 is equal to 0.81. Step 4, measure management skill. Return is equal to 0.81 divided by 5.56 is equal to 14.5%. Gillette earned 14.5% on every dollar of retained earnings. That is fantastic capital allocation. Example 2, General Motors, the struggler. Step 1, starting point, 1989. EPS is equal to $6.33. Step 2, total from 1989 to 1999. Retained earnings, $32.66 per share. Step 3, EPS in 1999. EPS grew from $6.33, $8.50. Increase is equal to 8.5. 0 minus 6.3. 3 is equal to 2.17. Step 4, measure management skill. 2.17 divided by 30. 2.66 is equal to 6.6%. GM earned only 6.6% on retained earnings. That's very poor. Investment results. Gillette versus GM simple explanation. Imagine investing $100,000 in 1989. Gillette, you'd end up with $1,600,000 plus. Annual return is equal to 31%. General Motors, you'd end up with $241,025. Annual return is equal to 9.1%. Same time, same starting money. One difference, capital allocation skill. This is why Buffett loves consumer monopolies, like Gillette. They require little new capital. They produce lots of excess cash, and their managers can reinvest it at high rates. Commodity companies? They swallow cash just to survive. No magic happens. Key takeaways. 1. Consumer monopoly is equal to better capital allocators. These companies turn every retained dollar into more profit. 2. Commodity business is equal to weak capital allocators. They retain money, but high costs and competition eat the returns. 3. The retained earnings test is easy and powerful. Just compare total retained earnings, EPS growth over time. 4. The stocks of good allocators make shareholders rich. Gillette turned investors into millionaires. GM, not so much. Chapter 21, Financial Calculation 12. The Internet and Warren's Short-Term Arbitrage Commitments. Imagine you're sitting in front of your laptop on a calm morning. The market's open. In one tab, you see a company announcing a buyout. In another tab, you're watching the stock price of that same company trading below the buyout price. A tiny gap, maybe 50 cents, maybe 10 cents, maybe 1 cent. Most people ignore it. But the legendary Warren Buffett saw these gaps as golden bridges, small but safe ways to walk from today's price to tomorrow's guaranteed payout. This quiet little game, known as arbitrage, helped Warren earn fortunes, even when the overall market was falling apart. Let's understand how this works, through a simple story and the wisdom of Warren. The Internet era, when arbitrage became a game for everyone. Just a few years ago, arbitrage was reserved for the big guys' hedge funds, banks, and investment houses. Why? Because transaction fees were huge, sometimes wiping out all profits for small investors. But then came online trading. Suddenly, Fees dropped from high commissions to 1 cent per share. Some platforms even offered free trades with certain minimum balances. For the first time in history, the small investor could play the same game Warren played, catching the tiny spread between what the buyer will pay and what the market is currently offering. And that tiny spread, if repeated many times, could create stunning returns. Warren and the arbitrage game. Arbitrage, or as Warren calls it, workouts, is one of his lesser-known but extremely profitable talents. A workout opportunity typically comes from mergers, acquisitions, liquidations, reorganizations, spin-offs, and corporate takeovers. Warren's first choice is always buying great businesses for life, but when those aren't available, he shifts to arbitrage to keep his cash working. And he has averaged around 25% annual pre-tax returns doing this for decades. That's incredible. A story from the early days. In the early Buffett partnership years, sometimes 40% of the fund sat in arbitrage positions. In 1962, when the entire market was collapsing, Buffett partnership plus 13.9%. Dow Jones minus 7.6%. His value stocks actually lost money. But arbitrage positions, predictable, short-term, and almost locked-in saved the year. This shows a powerful truth. Good arbitrage can protect you even when the whole market is burning. How arbitrage works. A simple story. Let's say Company X is being bought by Company Y for $110 per share. But today, the market is offering you the stock at $100. This gives you a guaranteed-looking spread. Profit is equal to future buyout price minus today's market price is equal to $110 minus $100 is equal to $10 per share. So far, it looks easy. But here's the important question. When will the deal close? Because the annual rate of return changes with time. Let's see how time changes everything. Understanding time and return. Simple explanation. Think of your $10 profit like a fixed gift. You will surely get it, but the timing decides how valuable it is. Case 1. You wait 12 months. Return is equal to 10% per year. Case 2. You wait 2 years. The same $10 takes longer to arrive. Return drops to 4.9%. Case 3. You get paid in 6 months. Same $10, but in less time. Return jumps to 21%. So the shorter the holding time, the higher your annual return. And the longer the delay, the worse it becomes. Risks in arbitrage. Arbitrage seems safe, but life is full of surprises. Things can go wrong. Shareholders may reject the deal. Regulators may object. Tax rulings may delay. Lawsuits may appear. Mergers may be canceled. Warren reduces risk by following a simple rule. He only plays after the deal is publicly announced. Wall Street often gambles on rumors, but Warren waits for certainty. He prefers a safe 25% return he can count on over a flashy but uncertain 100% return. The Graham equation made very simple. Benjamin Graham, Warren's teacher, created a formula to measure the attractiveness of an arbitrage deal. Don't worry, it looks complicated, but we'll break it into easy pieces. The original formula, annual return, is equal to CG minus L, 100%. Minus C divided by YP. Let's simplify what it means. Simple explanation of each variable. Think of it like calculating your risk-adjusted annual return. G is equal to gain if things go right. L is equal to loss if things go wrong. C is equal to chance of success as a percentage. I is equal to how long you will hold the stock in years. P is equal to price you pay today. What the formula does, it takes your expected profit G, adjusts it for the probability of success, C, subtracts the probability-weighted loss, then divides the final number by the time you must wait, the price you paid. This tells you your annual rate of return, considering both reward and risk. Bayuk Cigars, Warren's real-life example. In 1982, Bayuk Cigars announced they would sell their cigar business. They would liquidate and pay shareholders. Shareholders were estimated to receive $7.87 per share. Warren bought shares soon after the announcement at $5.44 per share. Let's calculate his numbers. Step 1. Calculate gain, G. Profit is equal to $7.87 minus $5.44 is equal to $2.43. Step 2. Estimate chance of success, C. Deal approved plus liquidation, announced. Warren assigns 90% success. Risk-adjusted gain is equal to 90% of $2.43 is equal to $2.18. Step 3. Estimate loss, L. If deal fails, price goes back to $4.50. Loss is equal to $5.44 minus $4.50 is equal to $0.94. Chance of failure is equal to 10%. Risk-adjusted loss is equal to 10% of $0.94 is equal to $0.09. Step 4. Estimate time, Y. Liquidation must happen within the fiscal year. 1 year. Step 5. Plug values into formula. Annual return is equal to 0.9 multiply by 2.4, 3 minus 0.1 multiply by 0.94 divided by 1 multiply by 5.44. This becomes annual return is equal to 38%. A 38% return in 1 year with low risk. Warren did this again and again. Warren used this approach across many companies. RJR Nabisco, General Dynamics, Kraft Foods, Federated, Interco, Layer Siegler, Marine Midland Bank, and many more. Some years he had 20 positions. Some years none. He only invested when the deal was announced. The spread was attractive. The timing was clear. The risk was low compared to reward. How you can start in the internet age. It's easier today. A website like mergerstat.com lists all announced mergers daily. Just do this. Note the announced buyout price. Compare it to the current market price. If there's a meaningful spread, call the company or read SEC filings. Confirm the deal is still active. Use the simplified Graham formula to calculate return. If the return is attractive, invest. And always remember, never play arbitrage based on rumors. That's gambling. Play after the announcement. That's investing. Key points from this chapter. 1. Arbitrage helped Warren win even in market crashes. When his normal investments were losing, arbitrage profits kept returns positive. 2. Warren only plays after deals are officially announced. He avoids risky rumor-based speculation. 3. The internet made arbitrage accessible to small investors. Low fees mean even tiny spreads can create profit. 4. MergerStat and similar sites help you track mergers. Use them to find opportunities. Then apply the Graham formula. Chapter 22. Doing It Yourself. The Buffettology Worksheet. Imagine this. You're sitting at your desk with a cup of tea, your favorite notebook, and the excitement of someone about to unlock a treasure chest. You've read about Warren Buffett, you've practiced the ideas, and now, finally, it's your turn to do what the Oracle of Omaha does. This chapter is like getting Warren's personal checklist, the same mental flashlight he uses to shine light into a business before he invests. Think of this worksheet as your own treasure map. Follow each step correctly, and it leads you toward finding extraordinary investments. Let's begin the journey. 1. Does the company have a consumer monopoly? Warren loves a business that customers keep coming back to, almost automatically like Coca-Cola, Gillette, or American Express. To test this, ask yourself, can I explain this company's advantage to a 7-year-old? If yes, it might have a monopoly-like advantage. If no, walk away. Warren would. Write it in kid language. People choose this company because if you can't fill that blank in 10 seconds, it's not a consumer monopoly. Your turn. Describe the consumer monopoly here. Write your answer. 2. Do you understand how the product works? Warren believes something powerful. If you don't understand how it works, you can't know if it will disappear. Understanding prevents you from investing in businesses that become obsolete like floppy disks, pagers, or VCRs. Explaining the product. Try to describe how the product works in 1 or 2 short lines. Your turn. Explain how the product works. Write your answer. 3. Will this product still exist in 20 years? Warren always asks, will people still be using this product 2 decades from now? If yes, continue the analysis. If no, close the book, watch a movie, and start fresh tomorrow. Ask yourself, will it be replaced by technology? Is it just a trend? Is it essential? Your turn. Explain why this product won't be obsolete in 20 years. Write your answer. 4. Is the company a conglomerate? A conglomerate owns several different businesses. Warren looks inside it. Does it own strong monopoly-type businesses? Or is it full of average commodity-type businesses? Remember, commodity businesses go up and down with economic cycles. But this fluctuation sometimes makes great companies temporarily cheap. Your turn. List out. Consumer monopolies. Right here. Commodity businesses. Right here. Also check. Is management buying more monopoly-type businesses or more commodity-type ones? 5. What is the company's EPS, earnings per share, history? EPS is like the company's report card. Strong and stable EPS, great. Weak or unpredictable EPS, danger. But one bad year can be a golden opportunity. If EPS is stable, calculate its annual EPS growth for 10 years. Simple explanation of the formula. Think of it like this. Present value, PV, is equal to EPS 10 years ago. Future value, FV, is equal to EPS today. N is equal to 10 years. Press CPT, I to get the growth rate. This gives you how fast EPS is growing each year. EPS table. Just write the numbers for each year. 6. Does the company earn a high return on shareholders' equity, ROE? Warren wants 15% or more. ROE is simply, how much profit does the company make compared to the shareholders' money in it? High ROE, the company grows fast. Low ROE, slow boat, bad for wealth building. Your task. Collect ROE for the last 10 years, add them, divide by 10. This gives average ROE. If less than 15%, Warren walks away. 7. Is the company conservatively financed? Warren prefers companies with very little long-term debt. A simple test. Formula. Years needed to pay off debt is equal to total long-term debt divided by net earnings. If the answer is 1 to 3 years, excellent. 4 to 6 years, acceptable. 7+ years, risky. This tells you how strong the business truly is. 8. Is the company buying back its own shares? Share buybacks increase your ownership without you paying anything more. To check, old shares minus new shares is equal to shares bought back. Positive number, good. Negative number, company issued more shares, bad. Look at 10-year data if available. 9. Can the company raise prices with inflation? This is a superpower of monopoly-type companies. If a product cost $10 20 years ago and today costs $22, it means it can raise prices and still keep customers. In simple terms, use PV is equal to price 20 years ago. FV is equal to price now. N is equal to 20 years. Précipité if the rate is 4% or higher, strong monopoly. If the result is negative, it's probably a commodity business. 10. Is the stock price affected by panic or bad news? Warren loves buying great companies. During recessions, when the industry is in trouble, when the company has a fixable problem, bad news is equal to cheap price is equal to great opportunity. If none of these are happening, you are probably paying full price. 11. What is the initial rate of return? Initial rate of return is equal to earnings per share divided by stock price. Example, if EPS is equal to $10 and stock price is equal to $200, 10 divided by 200 is equal to 0. 0.05 is equal to 5%. Then add the EPS growth rate you calculated earlier. Compare this with U.S. Treasury bonds. If Treasuries pay more, stock may be overpriced. 12. Equity bond comparison, Buffett's favorite. This is one of Warren's smartest tools. Simple explanation. 1. You calculate how fast shareholders' equity grows. 2. You project the future value of that equity 10 years from now. 3. Multiply future equity by ROE gives future earnings. 4. Multiply future earnings by the average P/E ratio gives future stock price. 5. Compare future price to today's price gives expected annual return. It's like seeing the stock's future selling price today. 13. Projecting return using EPS growth. This has 2 steps. Step 1. Find EPS growth from 1990 to 2000. Use PV is equal to EPS in 1990. FV is equal to EPS in 2000. N is equal to 10. Press CPT. Step 2. Use that growth rate to predict EPS for 2010. Then multiply by average EPE gives projected stock price in 2010. Finally, projected annual return is equal to future price divided by current price CPT, II. This tells you how fast your money will grow. The final decision, do you buy? Here is Warren's philosophy. If it is a consumer monopoly, and you understand the business, and the price makes business sense, buy with both hands. But if it's not a consumer monopoly, forget it. Go for a long walk. If it is a monopoly but priced too high, wait for recessions, scandals, panic. The world will give you another chance. Chapter 23, Bringing It All Together. Case Study. 1. Gannett Corporation, 1994. A Warren Buffett detective adventure. Imagine you're standing in a giant library filled with thousands of companies, each book representing a business, each page representing financial secrets. Now imagine Warren Buffett walking through this library not with a magnifying glass, but with something more powerful, a calm mind, a simple checklist, and an ability to see the future earnings of a business as clearly as looking down a long, straight road. This chapter is like following Warren through that library, watching him stop, study, eliminate, and finally pick companies that will make him billions. Our first stop? A company you've probably touched hundreds of times without realizing it. Gannett Corporation, the parent of USA Today. Let's follow Warren as he studies it like a detective studying a case file. Part 1. Doing your detective work. In 1994, during a tough advertising recession, most investors were scared of media companies. But Warren Buffett? He walks toward fear, not away from it. He quietly buys 13.7 million shares of Gannett for an average price of $24.45 per share. Why? Because Warren wasn't buying a newspaper stock. He was buying a consumer monopoly with a river of predictable cash flow. Let's go through his thinking, step by step, just like a detective. Step 1. Does Gannett have a consumer monopoly? Warren loves businesses where customers have no real alternative. And Gannett? They owned 190 newspapers, and most were the only newspaper in town. When you're the only newspaper, advertisers must come to you. That means steady money, steady demand, and pricing power. Warren's verdict, a wonderful business. Step 2. Do you understand the business? Warren always says, never invest in a business you cannot understand. Gannett's business is simple. People buy newspapers. Businesses pay to advertise. Local monopolies is equal to predictable revenue. USA Today dominates national newsstands. No complicated technology. No rocket science. Just plain steady business. Verdict, easy to understand. Step 3. Is Gannett conservatively financed? Let's simplify this. Long-term debt, $7,067 million. Shareholders' equity, $1.8 billion. To check safety, Warren asks, if things go bad, can the company pay off its debt easily? Gannett earned $465 million in 1994. At that pace, it could pay off its debt in 2 years. That's strong. Verdict, safe. Step 4. Do earnings. Show an upward trend. Now Warren opens Gannett's earnings record, almost like flipping through a company's report card. In 1984, Gannett earned about 70 cents per share. A few years later, by 1988, those earnings had grown to $1.13 per share. By 1992, they reached $1.20, and in 1994, they climbed further to $1.62 per share. Imagine climbing a staircase. Each step takes you higher than the last. That's exactly what Gannett's earnings looked like. step after step moving upward. There were only two small pauses in 1990 and 1991, when the advertising industry went through a recession. But once the economy recovered, Gannett's earnings continued their upward climb. To Warren, this is beautiful. Steady rising earnings mean the business is predictable, and predictable earnings mean you can reasonably estimate future profits. That's the kind of certainty Warren looks for. Verdict: strong and steady growth. Step 5. Does management stay in its circle of competence? Gannett sticks to newspapers, radio, TV stations. No wild experiments. No foolish diversification. Verdict: focused. Step 6. Is the company buying back shares? Between 1988 and 1994, Gannett bought back 42.4 million shares. Why is this good? Because fewer shares is equal to your slice of the pie gets bigger automatically. Verdict: good management behavior. Step 7. Are retained earnings used wisely? Retained earnings, $5.82 per share. Increase in earnings because of them, $0.92 per share. Simple formula. Return on retained earnings is equal to increase in earnings divided by retained earnings is equal to 0.92 divided by 5.8. 2 is equal to 15.8%, meaning every $1 management reinvested earned 15.8%. Amazing. Verdict: very efficient. Step 8. Is return on equity above average? Average ROE in America is equal to 12%. Gannett's ROE history, mostly around 19 to 25%. This means Gannett turns every $1 of shareholder money into $0.20 plus profit. That's elite performance. Verdict: outstanding. Step 9. Can the company raise prices easily? Newspaper prices over time. 10 cent to 25 cent to 50 cent to $1. And advertisers must pay for ads. Gannett is equal to pricing power. Verdict: monopoly-like. Step 10. Are capital expenditures low? Newspapers and TV stations don't need frequent upgrades. Once the printing press is installed, it runs for decades. Low capex is equal to more money kept as profit. Verdict: low maintenance business. Summary of detective findings. Warren concludes, this is my kind of business. Predictable, dominant, profitable, and run by smart capital allocators. But wait, even a great business is not automatically a buy. Now we must ask, does the price make it a good investment? This is where Warren becomes a financial sniper. Let's walk through the price analysis in story style. Part 2. Price analysis. Warren asks two simple questions. If I buy today, what return am I getting? How fast will that return grow over time? Let's calculate these. Initial rate of return. In 1994, earnings per share is equal to $1.62. Warren's buying price is equal to $24.45. So initial yield is $1.62 divided by $24.45 is equal to 6.6%. Think of it like buying a rental property. You pay $100. It gives you $6.60 rent per year. Same idea. Comparing it to government bond. Government bonds in 1994 paid 7%. So why buy a 6.6% yield? Because Gannett's earnings grow. Bond earnings don't. This is Warren's equity bond concept. I'm buying a bond whose interest payment goes up every year. Projecting future earnings with simple story logic. Now comes Warren's favorite part, peeking into the future. He looks at Gannett's past and sees that its earnings have been growing at about 8.75% per year. So he makes a simple assumption. If the business keeps doing what it has been doing, its earnings will keep growing at roughly the same pace. In 1994, Gannett earned $1.62 per share. To estimate next year's earnings, Warren simply adds 8.75% growth. Think of it like planting a money tree. Year 1, the tree gives $1.62. Next year, it grows a little stronger and gives about $1.76. The following year, it gives roughly $1.91, then $2.08, then $2.26, and so on. Each year, the tree grows bigger than the last. Following this steady compounding path, Warren estimates that by the year 2004, Gannett's earnings could reach about $3.74 per share. But Warren doesn't stop there. He also knows Gannett pays out part of its profits as dividends. Historically, the company gave shareholders around 40% of its earnings as dividends. So Warren assumes this continues. Adding up all those yearly dividend payments over 10 years, he estimates a total dividend pool of about $10.52 per share flowing into the investor's pocket. In simple words, earnings grow every year. Part of those earnings come to you as dividends. The rest stays inside the company to make it even stronger. That's the quiet engine of compounding at work. What could the stock be worth in 2004? If Gannett trades at its low historic PE, 15, $3.74 multiplied by 15 is equal to $56.10. If it trades at its high historic PE, 23, $3.74 multiplied by 23 is equal to $86.02. Add dividends. Low case total value, $66.62. High case total value, $96.54. Now calculate return from $24.45 to $66.62 or $96.54 over 10 years. This gives 10.55% to 14.72% per year. Part 3. How accurate were Warren's projections? Now comes the moment of truth. Warren has made his careful projections, but time has passed, and real results are now in front of us. So, let's see how close his predictions came to reality. In 1997, Warren expected Gannett to earn about $2.08 per share, but the company actually earned $2.50 per share, roughly 20% higher than his estimate. In 1998, he projected earnings of $2.26 per share. Reality delivered $2.86 per share, about 26% more than expected. In 1999, Warren estimated $2.46 per share. Actual earnings climbed all the way to $3.30 per share, nearly 34% higher than his projection. What does this tell us? Gannett didn't just meet expectations, it beat them year after year. Because earnings were rising faster than predicted, investors took notice. The stock market rewarded this performance by pushing Gannett's share price above $70. And Warren? He bought at $24.45. If he sold near $70, his money grew at roughly 19% per year, far better than even his optimistic forecast. The teaching moment. Warren didn't need perfect predictions. He only needed a great business, bought at a reasonable price, with earnings that grow predictably. When you get those three right, reality often turns out even better than your expectations. And that's how Warren keeps smiling all the way to the bank. Closing lesson of case study 1. Warren's magic doesn't come from prediction. It comes from buying wonderful businesses at good prices with predictable earnings and letting compounding work